Members, good evening. Namaste. ICA Bangalore branch welcomes you to this today's study circle meeting on know the tax return form and ITR filing for the assessment year 2026-27 Income Tax Act 1961. To develop upon this, we have with us Kaushik Raj sir. I now request Chairperson CA Kavita Parmesh to kindly escort the speaker on to dais and welcome him with the knowledge book. Members, now I request our Chairperson CA Kavita Parmesh to kindly give welcome address.
Good evening and a warm welcome to each one of you to this study circle meeting on tax return forms. And before I proceed with anything, I welcome Kaushik also. Thank you, Kaushik, for being with us today. The idea of this study circle meeting was, now anyway we are getting into the tax return season. So before we get into that, we should be prepared enough to do that. And every year we see that there will be changes in the form, and this year also there are changes in the forms. So that's when we thought we will have the session where he will take us through the complete forms and get into the more details on the disclosure, additional disclosure requirements. So there will be a lot of learning. I would request each one of you to take up this and then learn. Also, like every week I say, we need your feedback. Please give the feedback, and also suggestions on what other topics you would like us to cover, which is also important. Have a look at the schedules which are there. I would like to just give a brief on a couple of other events which are coming up now in this month. One is this Saturday we are having litigation, a moot tribunal hearing. That means it was a part of the program where we did a theoretical session giving a gist about the litigation. After the sessions in both under income tax and GST, 12 members were chosen from the based on an assessment, and those members, chosen members, have been undergoing trainings through our mentors. The mentors are the people, experts who have been dealing with litigation on a day-to-day basis. Be it Jatin Christopher sir or Rajesh Kumar when it comes to GST, Prakash Hegde and Siddesh Gaddi and Deepak Chopra when it comes to income tax. So now they are all ready. We have an actual bench which will be sitting on that day. This is at Sheshadripuram Law College, where we are setting up the entire, simulating the tribunal experience. And for that we are inviting two bench members for GST. It is Banu Murthy and Advocate Banu Murthy and Advocate Lakshmi Menon. Where these people, 12 people who are prepared, they will be taking the roles of both department as well as the assessee side representation. They will be presenting their arguments on that day. Similarly, for income tax tribunal, we have the present sitting will be Prashant Maharshi from tribunal coming as the bench member. So it will be a feast to watch and see how they are prepared, and also it is not just watching, we will also have a lot of learning, because how to present everything, because these people will not judge the technical part of the subject are going to be that, but then the art of representation and how to take up litigation, the intention was this, so therefore that will be a good thing. So I would request all of you to register and then take up. Apart from that, we are coming up with a lot of certification courses. Data privacy, which is becoming a most important one, and everywhere if you take up any assignments with any foreign clients or internally within the clients also, you have to sign up these agreements. So therefore the understanding DPDP we are coming up with as a certification course. AI certification course is definitely happening. Every week there is AI certification course. We are doing right now the module 2 is also going on for AI. I would request all of you to take advantage of that. And then the sports day is coming, not just always talking about the subject and then learning. We are also having some fun through the sports day. This time we are doing along with KSCA. It is not just the branch. So again, the pickleball and the box cricket. Considering everybody, we said that it should be something which is made available for everybody. So therefore box cricket. I'm too keen to see any women teams coming up for any of these. See if the women members can come up, and then if we can have at least 4 teams we can do. Without 4 teams we cannot do, because we'll have to have 2 rounds. So if when women members can come forward and form a team and then have any of this, it will be very nice. I request all the members to consider that. Apart from that, most important thing is the RRC, which is on the cruise. The early bird offer is getting over by tomorrow. So have a look at it. Seats are also filling. Lot of good interest have been. I was quite happy with the kind of response which members shown on this. I would request all of you to look at it and then register before the early bird expires. With this, of course, there are two more important seminars coming. This full day seminars we are doing. One is on the cooperative audits, where whoever is doing the cooperative societies audits, then you will have that. Apart from that, one day seminar on 30th September, 30th May, which is a Saturday, on FEMA workshop. Many of you have attended the certification course on FEMA. There were some feedback on that where they said that okay, this became a lot of theory, but we also want to know practically how to do. So it is kind of a workshop. While we are calling it a seminar, it is kind of a workshop, taking through each and every form, how you have to fill up, what needs to be done, apart from giving the legal side also. So that will also be a good learning. I would request you all to take advantage of that and learn. And today, please have a good learning and ask as many doubts as you can and trouble the speaker as much as you can, so that you can get the best out of it. Thank you and a good learning to you all.
Thank you, Chairperson Ma'am, for a brief address. Members, it gives me immense pleasure to introduce our today's speaker, CA Kaushik Raj. CA Kaushik Raj is the founder of Kaushik and Shivram Chartered Accountant with over 11 years of professional experience in direct tax and management consultancy. He has extensive expertise in handling taxation matter for multinational corporation, including representation before the tax authorities such as CIT and appellate authorities during his tenure with the Big Four firm. He has advised clients across manufacturing and services industries and possesses strong experience with business structuring from incorporating to funding. A regular speaker on direct tax, he has presented paper for professionals and industry members. For the past 9 years, he has also been mentoring CA, CS and CMA students in direct taxation at colleges and private institutions. He is an IBBI registered valuer for the assets classes, securities and financial assets. Sir, we are eagerly looking forward for your session, insightful session. Now stage is yours. Over to you.
Okay, to start. Okay. Anyways, first let me place on record my sincere gratitude and acknowledgements for inviting me, the Bangalore branch entire, the managing committee members, the chairman Kavita Madam and the SICASA chairman Vinod Garg and all the other executive committee members also. So I thank them for inviting me here. So this gives me a lot of confidence in terms of getting myself prepared for the knowledge for the subject and enhance the skills and knowledges. So that gives an opportunity for us also to learn a little more deeper rather than being learning on the surface level, isn't it? If we do for ourselves, we'll only see what is required. But when we do in-depth analysis for any other session, for any other seminar or conference, then we go in detail and see all kinds of differences or all kinds of challenges or aspects, practical aspects into it. So that this gives me an opportunity to prepare in such manner. So thank you, Bangalore branch, for giving me this opportunity. So today's session, we all know that this has nothing to do with Income Tax Act 25. Yes? Why? Income Tax Act 25 is applicable only for financial year starting from 1st April 26 onwards. So today we are particularly talking here for assessment year 26-27, that means previous year 25-26. So previous year 25-26 is the year for which now returns are falling due in the next couple of months. So we'll start seeing the ITR forms, how it has been released on 30th March or 31st March. In the month of March itself, the CBDT has come up with a new set of forms applicable for assessment year 26-27. So let us see how these forms are changed and what are the different reporting aspects that we need to keep in mind. Okay, that will be the coverage. However, initial few minutes will cover the new changes that have happened, which we need to keep in mind for next year and current year, or in terms of the return filing architecture. Okay, so we'll see in terms of, you'll be able to see that the segment is mostly focused upon ITR 1, ITR 2, ITR 3, ITR 4, 7 different ITRs. And one major ITR which is not familiar is ITRU. correct? ITRU is now last 3-4 years, it has been recently born ITR, correct? Baby ITR, isn't it? But it has lot of coverage up to 4 years prior to which you missed filing ITR can be filed. So ITRU is there, and what is ITRB? That is the acknowledgement. We'll see quickly what are the changes that are happening. Okay, first let us see what is the architecture, the return filing architecture. How is that? What are the different types of filings that are applicable? Now, what is how many types of return that we can file? 7 returns. Okay, that is the different forms that are available for filing the returns. But what we call as the original return, and then we have something called as revised return, and then belated return, and then updated return. So now we have the, if you can remember 139(1), that is the original return. The new section in the Income Tax Act 2025 is going to be 263 subsection 1. Okay, and then it becomes belated return. And there are certain changes that have happened in Finance Act 25 and 26 in terms of belated return, the timeline and the late fees, all of those in terms of revised return as well. So we'll try to spend some time to understand those things as well for us to get a better insights in terms of something that we are filing belated return and revised return. What is the difference? Earlier it was same, now there are some changes that has happened which is applicable for assessment year 26-27 also. We'll spend some time to understand in that aspect. So this is clear. So we had ITR 4 types of return, right? One is the original return, and then you had revised return, and then you have belated return, and then you have the updated return. So these are the 4 different types of return, and just given the comparison between the section number references in the ITA-1961 and ITA-2025. Okay. Let's move on to small different change that is applicable from the current year, the due date. Now these due dates are, we had every time 4-5 years back, we used to have 31st July and 30th September as the date. Correct? 31st July and 30th September as the date. And then the 30th September became for audits, and then the ITR due dates went to 31st October, and then transfer pricing came into picture, and then transfer pricing due date, it was 31st October, it was gone to 30th November. So 3 due dates we will have. One is for regular assessees or individual assessees other than tax audit and transfer pricing case assessees, that is 31st July. And we had 31st October for all tax audit cases and 30th November for all transfer pricing cases. Now, you must have seen in terms of the budget announcements that has come through, where it has been telling that, where it was told that another due date has been brought in. Whatever was applicable up to 31st July, that has been split into 2. Okay, so that means to say what is applicable for 31st August. So now for this year, we need to focus not all cases first, or the due date is not for everybody other than audit cases in the case of 31st July. So the 31st July return will be applicable only for non-business assessees. So the due date of 31st July is going to be only for non-business cases. Non-business cases means which are ITRs that you can think of? 1 and 2. That's all? Nothing else. Only 1 and 2. So only ITR 1s and 2s is, if we learn today, that is sufficient. Again in June we can come and learn other ITRs. Isn't it? If we learn all the ITRs, nothing to limit to ITR 1 and 2. So then comes your non-audit assessees and trusts, or where you have other than non-audit, but they're business assessees. Okay? Other than trusts, other than audit cases. Okay? And other than those for whom date of 31st July is applicable, then that becomes 31st August as the due date. This is applicable for assessment year 26-27, and the same date is also available in the Income Tax Act 2025, that will be applicable from tax year 26-27 onwards, no change. Okay? And then we have regular audit cases, we need to file ITR by 31st October, and then you have transfer pricing cases, you will have to file by 30th November. But what is the due date for audit? 30th September. So since it is not an audit thing, I have not put that line. Otherwise, audit is 30th September. In case of TP, it will be 31st October as the audit due date. Now comes the timeline for, these are the original return timelines. Whatever we have discussed till now, these are the timelines for filing original return. We discussed original return. Correct? The first one was original return section 139(1), which is applicable for current year, and from next year onwards it will be section 263 subsection 1. So thereby, what we are discussing, what we discussed, these 4 or 5 different timelines, 4 different timelines is only for original return applicable to different class of assessees, isn't it? Now let us see what is the timeline for belated return or revised return. Very long back, the timeline for belated return was 1 year from the end of the assessment year, and then it was 2 years from the end of the assessment year. All of you remember? The new people might not remember because this was changed 5-6 years back, and then now it was reduced to 1 year, and then it was brought down to 9 months in the recent past, and it was applicable only 9 months from the end of the year. From the end of the previous year, basically, correct? So 9 months timeline was there, and that is continuing to be remaining same for belated return. And the same timeline was brought in line for revised return also, 9 months from the end of the previous year. So thereby we had 31st December 2026 for the current year, whichever we are discussing, financial year 26-27 or previous year, assessment year 26-27 or previous year 25-26. The due date, whatever we have discussed, 31st July 26, 31st August 26, 31st October 26, 30th November 26 is original return. The due date for belated return will be 31st December 2026. Thereby, revised return due date also was stuck at 31st December 2026. However, there is a change that they have made for assessment year 26-27 onwards. They have extended. Why have they made these changes? Now, somebody who has now you might have been seeing that income tax department is also proactive, right? All this while they give a lot of information for paying advance tax. They keep sending reminders, messages, and after filing returns at the time of due dates, whenever you have belated return due dates, on 31st December, on 27th December or on 28th December, they will start sending messages, right? The income disclosed in your return is X amount, and we see that the amount is significantly lower than what is available on the AIS. Or we see there are high transactions seen in your AIS transaction. So if required, do a check, and if you feel appropriate, kindly file the revised return. Correct? Or they might say, in some cases where return itself is not filed, we note that you have not filed the return of income, but however in your AIS or the information is available with the tax authorities, the significant transactions are reported. Thereby kindly review and, if applicable, kindly file the return of income. Now these notifications were coming at the very fag 27, 28, 29. So let's say in that hurry, if we file the belated return, and if something goes wrong in the belated return on 31st December, I am filing the belated return, and I discover on 2nd of January that some information is not appropriately filled. Now there was no scope for filing the revised return. Now you have to file a revised return, then the due date is again 31st December. 31st December is already elapsed. Now let's say somebody was filed in July, August, October or November. If they have filed the returns on time, or even if they have filed belated return in the first week of December or in the mid of December, if they discover that there is some mistake, if they discover there is some anomaly that they need to revise, there is a window. Let's say they filed belated return on 15th December, and if they discover it on 20th of December or 22nd of December, still they have time for filing revised return. Another 8 days is there up to 31st December. That is the scenario for whom? For those who file the return prior to the due date of belated return. Correct? If they file exactly on the due date of belated return, that is 31st December 2026, then where do I have the time if I discover any mistake or any miss out or anything that I have not reported? If I have to report, where is the chance for filing the revised return? So there was no opportunity, or the situation was such that revised return provision could not have been exercised by the taxpayer or the assessee. Isn't it? You are able to get this understanding? Practical inapplicability of a provision. Practically not possible to apply the revised return provision. Thereby, the revised return due dates were extended to 31st March 2027. Only revised return due date was extended to 31st March 2027, which is applicable for current year also. Thereby, for financial year or previous year 25-26, the due date for filing belated return is 31st December 2026, but the due date for filing revised return is now extended to 31st March 2027 by 3 more months. Okay, but this comes with another additional fee. Now already when we file belated return, we pay 234F late fees. Yes or no?
Yes.
Now when we file, when we pay this additional fee for belated return, and if we have to revise, then we will have to file another additional fee. They are not calling it as late fee. Belated return, late fee because I am filing later. Revised return, this is not late, this is additional fee. Yes. Yes, yes. So belated return also can be revised. Original return also can be revised. Belated return also can be revised. That is the discussion that we are having. If somebody files a late return on 31st December, or they have not opted for filing return on the same day, and then they go for belated return on 31st December. Until now there was no option for us to revise a belated return because of the practical inapplicability. But if somebody who has filed on December 15 and if they discover a mistake or unreported return, they could have revised it. Earlier also they could have revised, but now if somebody files it on 31st, this is happening because if income tax authorities would have given those preemptive messages on 1st of December, they would have filed by 15th December or 20th December, or if they would have given, all these are individual cases only for whom they are pushing these notifications. They could have pushed in August, they could have pushed these notifications in September, they could have given these campaigns, run these email campaigns or these message or precautionary messages in the month of September, October, November. But they've never done that. They do it always at the last time, and this is what we are observing from last 4 or 5 years. Now, also to have a background, why have they started sending these messages? So there is a small history or a kind of judicial observation. What happens is when we go for section 148 income escaping assessment, if somebody is not filed or if somebody is not reported any income or not at all disclosed any income, then income tax authorities can come and ask for 148A notice that your income has been escaped, isn't it? And they give notice after 3 years or 4 years, correct? Now, after 4 years, what will happen? Let's say the individual has sold a property, he has some 70 lakhs of sale transaction which is there and he has never reported. He thinks he bought it for 80 lakhs, he sold for 70 lakhs, there is a loss, so I will not file. So there is no payment of tax. I purchased for 80 lakhs, I sold for 70 lakhs. Since I sold it for loss, there is no need to pay any tax on this transaction, there is a loss. So this is an ignorance. Some of the individuals or rural areas, tier 2, tier 3 cities, they might not have information or they feel that there is no tax liability. Since there is no tax liability, they will be under the presumption or they might miss out to think that there is a provision that needs to be disclosed or a return has to be filed, and they go unnoticed and they would not have filed. But these transactions are now interlinked and reported in AIS. Since it is reported in the AIS, now the tax authorities have not come immediately. They were coming after 3 years. 148 notices were issued telling that we see there is a property transaction, immovable property transaction, 70 lakhs. Kindly file the return with interest, penalty and all of those, with interest and late fees. And then he will levy penalty also if he filed the return and if there was some income escaped, isn't it? But then these cases travelled on appeals and it went up to higher authorities. The question was, if income tax authority had the information, why are they waiting for 3 years to come and ask? They could have asked prior to that only. If they would have asked earlier, we would have paid, we would have saved on interest. At least we would have got to know that we should have filed. In genuine cases where they are not aware that the return has to be filed. So these are the situations which led the CBDT getting a harsh instructions telling that wherever you have information, you should have educated, created awareness, or you should have called for information wherever necessary. And that is when these information or campaign emails started running in terms of various aspects. It can be on the deductions that you have claimed, or HRA deductions, HRA claims that is made in old regime, or it can be in terms of donation claims that has been made, or it can be shifting of old regime, new regime, some form has not been filed, or foreign tax credit that form 10 is not filed, or 8990 relief claimed, there is a form 67 to be filed if you have not filed. All of this administrative issues is something which was taking away the benefit from the taxpayers. Okay, and these cases were went on to appeals, and then they instructed the CBDT to be proactive in giving the communications and start taking the information accordingly. Now this led to that, okay, CBDT started giving instructions or started sending these campaigns and the emails, but they sent that last minute, 3 days, 2 days. Yes sir? Is it mandatory? In which intimation? This information about the, not mandatory sir, it is a mass campaign to just to create awareness, and since the data is now available to that extent, they can trigger the emails to whom it is applicable also. Earlier they were sending mass campaign emails. Now they are also sending specific emails to whom the information is available. Now let's say I have a property sale transaction of 70 lakhs. They will send, in your case there is a transaction that is noticed, kindly look into it. That email will not come to everyone. Now if there is some other transaction, then that email comes to only that other person and not to me. So it depends upon what is the information given. Now because of this background, now we have that non-possibility of filing the return because they start sending the notices or the reminders of the last date, and all the assessees will not be in a situation to proactively come by themselves, or not that professionals have educated them and given awareness to them, they would not have taken it very seriously. When the message comes from income tax department or an email comes from an income tax department, then they will react. Not that their chartered accountants or practicing professionals would not have told that, and in many cases where the transactions are known to a professional would have advised, telling that you will have to file your return. They would have come and asked for some lower deduction certificate or 26 QB in case. Many of the property transactions now 26 QB is there. Earlier, now it is Form 141 from this year. Earlier to that it was Form 26 QB 1% TDS. Now this 1% TDS happens, many of them will get to know. Let's say now in April 2026, if somebody is selling a property, they have to deposit 1% TDS. Now today only the professional got to know that there is a sale. This professional would have, for sure, 100% would have advised that anyhow this sale is there, you need to calculate capital gains and you need to pay tax or file your return for tax year 26-27. Definitely would have told, but they will not take action and they will forget. And then December 2027, when the message comes, they will come again. Okay, and this is the situation which there was non-possibility of using the rights available for filing the revised return in cases of last minute filing of belated return. That is where this date has been extended. The revised return filing date has been extended from 31st December to 31st March 2027. 3 more months extra. Now, this again comes with the late fees, like I said, or the additional fees based on the slab rates. If the income is less than 5 lakhs in the revised return that you are filing, then it should be 1,000 rupees. If income is above 5 lakh, then there is an additional fee of 5,000. Okay? Let's say 31st July is the actual due date for a salaried person, he has not filed the return. Let's say he filed it in August, then he has to pay 5,000. If his income is more than 5 lakhs, he would have paid already under 234F 5,000. Okay? And if he realizes that there is a mistake and if he has to revise the return in the month of January, or any time, then if he revises it in the month of January to March, then he has to pay another 5,000 additionally on the revised computation that he is going to file. So this is 2 times levy that could come into picture in case of belated return once and revised return once. Yes, sir.
Is the revised return fee applicable for every revision or once?
This revised return fee is applicable for the returns filed for revision during the period of January to March. Now, for example, if I have filed, like I said in my example, July I have filed the original return, August I have filed, in July I was supposed to file, but I have not filed, but I filed a return for the first time only in August, so there is a belated return. Then I revise it before December. Then there won't be any late additional fee because it is revised within 31st December. So that in that case it won't come. But if it is revised after 31st December, Jan, Feb, March, then this additional fee comes. Now the question is, if I file 5 revisions, should I pay 5,000 5 times or is it only first time? The question is coming in such manner. We'll have to wait and watch the forms how they are charging it. In my view, it should be only 1 revision. Multiple revisions are possible and we'll have to wait for it. Or they might also restrict. Revision is possible in Jan to March only once. So use the right wisely. So rather than asking you do 5 revisions, give me 5,000 every time, restrict it to only once, pay 5,000, use the right that is available wisely in one chance, in one go. Probably that might be the possibility in my view. We'll have to wait and watch to see how does it look like. Okay. So this is the one change or one revision that we need to keep in mind that is available. And like we said, we also have to enforce this opportunity or right wisely, and we cannot tell we'll file one revised return and then see if there is any other return, anything else to be disclosed, then we'll see later. Okay, most of the times what happens, information is not available. Sometimes all the information is not available, and sometimes it is only disclosure information not available. So we will tell file the return, then we will revise. Okay, or income wise also certain time we know that there is some more income. We know that assessee has some 30 lakhs of income, but information is available to the extent of only form 16 salary of 17 lakhs. Another extra income we don't know. We get to know later. Now we'll file the return for salary, then we will revise. So these are the situations at which it can happen that we'll have to file a revised return, and then when we are filing revised return, we'll have to be mindful that whether we will have another opportunity or not, multiple option is available or not, and then accordingly we might have to enforce or use the rights and privileges given. Okay. Now similarly, Finance Act 2026 has given one more change or one more amendment with respect to using the rights available or exercising the option under section 139(8)(a), that is ITRU, or in the new section it is 263 subsection 6. Okay. We had 2-year time limits with which we could have filed earlier. First, it was introduced that 1 year prior you can go 25% extra tax, and if it is 24 beyond 12 months and within 24 months, then you have to pay additionally 50% of the total tax payable. A new section was introduced, section 140B, where we were filing the return by paying additional tax of 25% or 40%. And then later, this window of 2 years was increased to 4 years, with the slab rates being 25-50 as it is. Okay, and for the third year, if it is beyond 24 months and 36 months, they introduced a new additional tax rate of 60%, isn't it? And then 36 months to 48 months, how much? 70%. So it is 25, 50, 60, 70, up to 48 months. Now I can find the return. Again, what is the logic behind this thing? Now, if somebody wants to file, or if somebody wants to forgotten or wantingly or unwantingly or knowingly or unknowingly, let's say with intention or without intention, whatever is the case, if they have missed filing the return, now the window is available for 4 years, so that even if there is some kind of income escaping assessment that comes, then later on they might have to pay if it is triggering section 69 or something called as undisclosed income or unexplained cash credit or unexplained assets or unexplained incomes, then it will be triggering 60% tax rate, and then you will have to pay penalty, and then you will have to pay interest accordingly when they come and approach for it. Rather than that, now they are given you pay that by yourself, no penalty. Okay, this is itself is including penalty, something like that. So that is the additional thing that will come into picture. Now, in what cases we could have used this ITRU option? One is 48 months window, and then we have another thing, whether original return is filed or not. Even then we can file ITRU. There is no prerequisite that I should have filed original return, then only I can enforce or use the ITRU option. There is no requirement. Even if I have not filed, I can go with ITRU. Then they have given this one restriction once per tax year. So here there is a limit of, if I have to file for that year ITRU, only once I can enforce. I cannot enforce that right or exercise that right multiple times. Then here there was no filing fee additionally, except for that additional tax that was there. No filing fee additionally, and cannot reduce tax. If I have already filed the ITR original return and I have paid some tax, in ITRU I cannot reduce my income, reduce the taxability and claim refund. That was not permitted, and loss returns was not allowed. That means if I had a loss in a particular year and if I have not filed the return, ITRU was not available to be filed, or if I have already filed a loss, ITRU cannot be filed to reduce that loss. Okay, so that option was not available. Now they have come up with the amendment in the Finance Act 2026. They have come up with the possibility that even in case of loss, and if it is reducing the loss, you can file the ITRU. That is one change. And if there is any, the disqualification cases, if you read below here, if there is any such or requisition cases or any survey initiated or any notices under section 294 or 295 or any specified information under treaty exchange or any prosecution proceedings is initiated, then we cannot file this return. This includes 148 notice also. That means if there is any income escaping assessment notice issue, then I could not avail the benefit of ITRU because already assessment proceedings are started. Now, once the notice comes, you cannot run and go and file ITRU. Okay, that was the limitation that was existing. But now they have come back. If you have any notification or if there are any 148 notice that is coming in, that also can be utilized. Even if you have 148 notice issued, ITRU can be filed in response to 148 notice, Thereby, you will have a limitation of penalty that is going to come if you have to go file your return by yourself. Okay? If you have received notice for 22-23, even for 22-23 you can file, 23-24 also you can file. Yeah. No, what you are getting is in terms of the applicable from 1st April 26-27 onwards, or Finance Act 26, this provision has been given in the picture. Now you can enforce, you get a 148 notice, you get a drop down there, whether you will have to file a 148 return or you will have to file a ITR. So you will be notified with the option from the previous years. We will have to exactly calculate whether 22-23 will come into picture or 23-24 or from when, then accordingly it will be applicable. You can do it for the earlier years. ITRU you can do it by yourself. 148 you will have a limitation to which extent it can go. They will issue that in the notice. ITR return filing in response to notice drop down will be there, you can select it. Correct. Now we'll have to check whether the notice was issued prior to the amendment or after the amendment or for which year. If the notice was issued before 31st March 26, then that would be under the before amendment. Then for that it will not be available. Any notice that you are going to issue now, then you will get that leverage.
Now it's from April 26 onwards.
Correct.
So I will see 27 and
Anything, correct, roughly, correct.
In the case of loss being reduced, do I have to pay additional tax?
There won't be any additional tax for that, and then hence that is the reason by which they had not allowed earlier. Now they will make the necessary changes to the schema and it will allow to file it. I am only just reducing the loss. But let's come to that, sir. I think there is another situation. If the loss is reduced, then you will have to file ITRU for the subsequent years to reflect the further utilization of that loss in the subsequent years. Okay? So if you are reducing loss in a particular year, then you would have carried forward loss 80 lakhs in the current year. That means you would have brought forward loss in the next year for 80 lakhs. If you utilize that 80 lakhs loss in the subsequent year, okay? Let's assume that 80 lakhs is utilized in the subsequent year. Now if you feel to revise this earlier year by ITRU, by reducing the loss, let's say instead of 80 lakhs it has come to 75 lakhs. So 5 lakhs loss has been reduced. Now we have to revise the next year return also to enhance your income by 5 lakhs because you have excess utilized the loss of 80 lakhs. So thereby you will have to revise your next year return and then accordingly file the additional tax for the next year also. Then again that additional tax impact will come on the next year as well. So that is the...
but that is not critical, no?
Right.
If I had availed a loss of 5 lakh, suppose excess 5 lakh, as you said, and suppose my tax liability was, in the subsequent year my tax liability was huge, suppose, so if I am now, if I calculate, it should be like, suppose...
only difference, man, that to the extent of 5 lakhs.
75%, suppose it falls in like bracket 60%, 70%, 35%, then it will be like...
Correct, that 60% is on the additional, the tax liability plus interest. Or,
tax liability, if I am paying 50 lakh, additional 60% is like what?
correct, another 30 lakhs you will have to pay on 50 lakhs.
It is not practical, no. There will be some cap in that because 5 lakh loss only, for 5 lakh loss if I am adjusting that 5 lakh loss and you will have to do the maths.
The impact is only on 5 lakhs. The tax excess utilized or the income or the loss excess utilized is 5 lakhs.
Only on the 5 lakh.
Yeah, tax on 5 lakhs, on that 60% is what you will be required to be paid.
Oh, so if I...
Not on that additional tax of 60% on entire tax. Obviously, logically, nobody would ask to pay for already income of or tax paid on that income to be paid.
Okay.
Only on the differential part, what is excess utilized, and the tax impact on that. On the tax impact, whether the 25%, 50, 60, 70, whatever is there, that will be to be applied. Not on the entire tax. Not on the entire tax. Okay. So scenario 1, we discussed. One is ITRU for loss reduction, new permissibility. You can earlier you could not have filed. Now you can file. Now ITRU converts a return of loss into a return of income. That is the position flips from loss to positive. This is possible, that can happen. Or loss is merely reduced. I had 80 lakhs loss, I am reducing it to 75. That is also possible. But to do this, Plus, your original return, which is a loss return, should have been filed within the due date. Okay? If I have to disclose the loss for the first time, then there is no possibility of ITRU within the timeline. That is fresh return, that is not possible. Okay? Because it does not allow you to file a loss return. There is no payment of tax. Okay? And consequential impact can trigger cascading compliance for later years when attributes were utilized. That is what we discussed about subsequent year utilization. Then you have to revise. Now we are discussing only 1 year rippling effect. Let's say this out of 80 lakhs, 20 lakhs was utilized in subsequent year 1 and 15 lakhs utilized in subsequent year 2, and then 30 lakhs utilized in subsequent year 3. Then if it is used for 4 years, then all the 4 years you will have to revise the return. Until that entire 80 lakhs wherever, or the impact of wherever is there, that you will have to take care accordingly. Now again the challenge can come into picture. Let's say if 80 is reduced to 5 and if you are utilized in 5 different years, which year you will revise? The 5 lakhs could be utilized first year, which will have higher impact because this is the 4th year, 3rd year, 2nd year, 1st year. Okay? Now if I revise only first year, that 5 lakhs I will pay only 25% additional tax. If I revise 4th year, then I have to pay 70% additional tax. Now these things probably they might have to give an FAQ or a circular or an instruction to understand this rippling effect in what scenarios, how somebody as a taxpayer I will revise first year. As a department he will come and tell revise 4th year, you should have revised 4th year. I have paid there, now you pay here also. So these things are practical challenges. As of now, as of today there is no visibility. We will have to wait and watch for the actual practical cases, how does it come, and probably we might have to wait for some FAQs that might be released. Okay. This is what we were discussing in terms of notice. So ITRU is permitted in response to a section 280, that is 148 notice within the prescribed period. Once ITRU is filed, assessee cannot respond to the notice in any other manner. That means your 148 proceedings is something that it can be covered by filing, just by filing the return, everything will be subsumed into it. Now whether any other disqualifications, all other ITRU disqualification, that is in case of survey, prosecution or any other search or any other proceedings, there you are not allowed to file ITRU. Only in case of 148 proceedings they have given the relaxation. Probably in future years they might give that also. That's slowly starting now. Okay. Now, what was that we were filing if we file ITRU by ourselves? 25, 50, 60, 70. But when you get a 148 notice, and then you file ITRU, then you have to pay additionally 10%. Okay, this 25 will become 35, 50 will become 60, 60% will become 70, 70% will become 80 if you have using ITRU as a mechanism in case where you have received a 148 notice. If ITRU is filed in response to a 148 notice, then additional 10% will come into picture with the existing. Now 30% regular tax is there, interest is there, on that you pay 25%, now you will have to pay 35%. Okay, so 30% will continue to remain, interest continue to remain, that 1%, 234B, 234C, 234A, all of that will continue to remain, and on the total interest of 234A, 234B, 234C plus normal tax, on the entire tax liability, that is normal tax liability. On the normal tax liability, you will have additional tax liability of 35%. And then, if you pay that, you will be excluded or you will be resolved from all the other obligations. So, is this clear now? 25, 50, 60, 70 will become 35, 60, 70 and 80. Okay. So, let's see an example here. How does it look like? Now, let's say original return of income I have filed 50 lakhs. Okay. Original return of income 50 lakhs is filed. And tax plus interest on that computed is 15 lakhs. That was discharged. Okay. Then some income escape was noticed and the notice had come, or 20 lakhs is the income escaping notice that has come. So that means you should have ideally filed 70 lakhs. Now I can use ITRU because I have got an income escaping notice. Original return is filed. Now I can file ITRU. Yes or no? Yes. Now I can file. Now if I choose to file ITRU in response to this new amendment, what will happen to tax liability? Let's see. Updated return, total income will become 50 plus 20, that I have to file 70 lakhs of total income. Now on 70 lakhs, the total tax liability is coming 22 lakhs. Okay, earlier I had paid 15, now this is becoming 22. Additionally, I am required to pay 7 lakhs. Okay, let's say that additional tax is 7 lakhs plus interest is 1 lakh, total is becoming 8 lakhs. Okay, So this 15 is what I had paid earlier, and on 70 lakhs regular tax is 22 lakhs. So 22 minus 15 is 7 lakhs is the normal tax liability. I have to pay interest on that also. That interest is included here. Let's assume that is 1 lakh. So additional tax plus interest is 8 lakhs. Now let's assume this return is applicable, or return is to be paid for, let's say this is falling within the period of that 24 month slab. Okay, 24 month slab means how much I should pay? 50%. So 50% of what? 8 lakhs? Yes or no? Whatever is the incremental tax plus interest, whatever is the total tax payable, on that I will have to pay 50%. So 50% of 8 lakhs is 4 lakhs. All of you are with me, able to follow?
Yes.
So 4 lakhs. So now, since this is a new provision, that ITR now requires another 10% premium to be paid. Now that 10% of 8 lakhs again I have to pay, that will be 80,000. Thereby, I will have to pay 4.8 lakhs extra because of ITRU. Okay? 4.8 lakhs to be paid because of ITRU. If not, I would have paid only 22 lakhs in the first instance. Because there is a delay, 1 lakh interest has got added. That becomes 23, or 23 minus 15, 8. So 8, now additionally I am paying 4.8 lakhs. Now let's say I don't respond to this, or I don't utilize the opportunity given of filing ITRU. Then what happens? 148 proceedings will continue. Now 148 proceedings, when it continues, now he can judge upon conclusion or upon verification of all the proceedings, he can conclude whether that is a misreporting or an underreporting. Correct? In case of an underreporting, he will levy 50%. Now that 50% of incremental tax, 22 minus 15, 7, he can levy 50% of 7 lakhs, that is 3.5 lakhs. If it is completely misreporting, if it is underreporting, he will levy 50%. If it is misreporting, he will levy 200%. So 7 into 2, 14 lakhs. So only the differential, that tax impact of penalty itself is coming so much, and again interest on this will come into picture. Getting my point? And the tax rate, if it is considered as unexplained income, unexplained credit, if you categorize it under section 69, the normal tax will go up to 60%. So these are the multiple impact that will be there. Now here the impact is only 4.8 lakh. We can be done away with all these penalties. Penalties will get avoided. Whether it is 3.5 lakh or 4.8, 14 lakhs will get avoided. This what we are talking, now you can tell 3.5 is simple, no? Less than 4.8 I will pay 3.5. Somebody can think, normally if you are just observing the slide here, 4.8 is higher than 3.5. What? Now in this case it is underreporting only. I should have reported 70 lakhs, I have reported 50 lakhs, 20 lakhs is underreporting, it is not misreporting. And now since it is underreporting, my liability will be only 3.5, back 3.5, it is not like that. This is only the penalty quantum that is quantified here. There is tax impact, there is penalty impact, and interest on penalty also will be there. There will be huge impact that will come into picture, which can be saved by utilizing this ITRU option. Are we good with this? Time is also saved, peace of mind also, no litigation, no.
We don't earn money.
Correct. No, you will have to charge for advisory for all these things. Correct. My only observation in the past history is we accommodate a lot of things to our clients. That is where we don't get fees. The moment we make them realize that this is the provisions and this is the kind of thing, and slowly when we educate them and the kind of work and effort that goes behind to it, and it is demonstrated and established to an extent that they are able to resonate to it, they will be happy to pay reasonable fees. I am not telling premium. I am not telling, you are telling that they are not at all paying fees. I am telling at least reasonable fees can be expected. We don't put effort to create that awareness or get that aura to state that what is gone behind the scenes. In terms of late night thing, the staff working there, you don't know which section, software is not working, calling call center, portal is not working, taking screenshots and putting to grievance, 100 times calling that, waiting on press 3, press 7, press 9, wait, suddenly call gets disconnected, then say this is not the correct number, dial that number. All these things client does not know at all because we don't tell them. Finally we tell ITR file. Sometimes you might tell there is problem in the portal. The client will not even know what is the problem and what is the depth of the problem and what is the significant critical time spent on that is not known. Probably we all have to make that effort to explain or bring that on record or In one example, I think some time back, I had called the client to come and sit with me until the return is filed. He came to me on 29th, 31st was the due date. I told, come, then only I file the return. Without you coming, I cannot file the return. And it was not even a simple individual return, it was a business return. And I told him to come sit with me, and we worked. Clocked the night all the time with me along with two more team members, and I had asked the client also to come. We all had together dinner, lunch, coffee, tea, everything, and they were sitting quietly. We were only working. They did not work. Okay. Questions asked, answers given, clarifications given, risks explained, positions taken, everything explained on the table, over the table. This is what happens, sir. Not 1 minute phone call to tell that ITR filed, you are doing something, you are enjoying somewhere, you are going for movie, vacation, and resort something, and you finally get, and you also bombard us telling, what are you doing till now, it's not filed, it's already late, my friends are telling that it is already filed, I am not getting that news that it is filed. So come and see what is there. So this client, I intentionally did that because this client was also not having that seriousness. You cannot use the same strategy to everybody. And this client, all 3 days they were there with me, and on 30th or 31st, 30th also till morning, late morning, 3 o'clock they were there and they left. And then on 31st they came back again in the afternoon, 12 o'clock, and the return got filed at 7 o'clock. And we did not take any shortcuts because client was there. If client was not there, we could have taken some shortcuts. We did all detailed workings, team members, I got one extra team member, do all Excel calculations, fill everything properly. If you have to type in front of them, only no problem. If you have to reconcile in front of them properly. If you have to ask any questions, you ask. If you want any bill, you ask for it. Any statement you want, any clarification you want, loan statement, everything, whatever you want to ask, what is there, everything is asked, everything is explained, and they also got to know this is what the effort that is put in. So then they realized now, and for that client I told first pay fees. Tax liability, I don't know how much. My fees, I told 1,80,000, pay 90,000 in advance, and then you pay 90,000 afterwards. So for 3 days effort, we got fees of 1,80,000, 90,000 before starting the work. And on 31st December, then he said after filing we'll give. Then after filing, then he said, you want 2 more days? Then I said I will give 2 more days of time. And then afterwards, it took around 4th or 5th, we got the balance fees also. And next year onwards, he's coming on time. And the fees is half of it. I had only told double the fees for that effort, last minute effort. So this is something which it works. I'm not telling it will work for all cases, but we should also filter certain clients. If it is not suiting us, then we'll have to let go those clients. Somebody else is there who is free, not taking stress, but they're doing that work. Let them do it. And we'll have to do the work in the way that we prefer to do. Anyways, I digress, digress on the topic. Probably, I'm not sure if something is told what not to be told. Okay. Then there is another MAT credit utilization under new tax regime is now restricted. Now when you are doing your computations or filing a written off income, how many of you have come across in the MAT credit situations in your filings or in your cases? AMT credit or MAT credit? What is MAT? Minimum alternative tax? No. Not even a single practical case. Nobody is it. Then let's skip this. Then proceed further. Huh? I have done. Sorry, Salim. I have done. Please explain. Okay. Fine. So we have this minimum alternative tax 18.5% which needs to be paid if there is, for whatsoever reasons, if your normal tax liability is reduced on account of some exemption or some income based deduction. If your income is reduced and if you are not required to pay any tax because of some tax holidays, then you will have to pay a minimum tax of 18.5% on your book profit. Okay. Normal tax computation, your income is 0, you need not pay anything. Now book profits is added back with all these tax holidays and you arrive at the book profit, pay 18.5% on that. And this is not fair, right? One side you are giving tax holiday and one side you are telling pay 18.5%. Now they said it is not that you pay 18.5% and forget about it. We will remember, you will also remember. The next 15 years you can take that credit. In any subsequent year, if your regular tax liability is higher than your minimum alternative tax, the difference can be utilized. This is the concept of MAT credit or claiming credit in the subsequent year. Now let's say in the subsequent year, your regular tax liability is 70 lakhs and your MAT liability is 40 lakhs. Now, what is the difference? 30 lakhs is the amount. If you have any MAT credit, you can utilize. Now let's assume you had a MAT credit of 50 lakhs or 60 lakhs. Let's assume you had a 60 lakhs of MAT credit. Can you utilize entire 30 lakhs?
Yes.
Yes? You can utilize. That was the provision till now. But going forward, now that there is a restriction, you can utilize only 25% of the tax liability of that year. Okay? What is 25% of the tax liability of that year? 70 lakhs. 70 lakhs into 25%, 17.5 lakhs. Though you have 60 lakhs of MAT credit, though you were entitled to utilize entire 30 lakhs, now it is restricted to 17.5 lakhs. That means the carry forward will now be for further years, and if you cross that 15-year period, then it will get lapsed. Two impact. One is it is deferred for furthermore period. The second impact is if the deadline of 15 years gets over, then MAT credit unavailed or still lying in the balance as on 15th year will now get exhausted, will now have no value, and it gets deleted or it is not no longer available kind of thing. So two impacts is what we have to think of it. This restriction is coming from this year onwards, and anyhow we know that in case of new regime, MAT is not there. Somebody who is converting from old regime to new regime or paying tax under the new regime, that is 115 BAA and BAB, okay, not BAC. BAC is for individual, BAA and BAB is for companies or organizations or corporates. The people who have opted for these two sections is considered they have opted for new regime, and there is no concept of minimum alternative tax there. Whether you claim whatever it is, because that regime says that you don't get any tax holidays or any income-based deductions and exemptions, all of those. So pay a reduced rate of 22% or 15%, whatever is there, pay and be done away with it. Thereby there is no MAT concept itself. So they said there is no MAT credit in those cases. Also they said the moment you convert from the existing regular tax regime to the special regime or the new regime, then whatever MAT credit is available will get lapsed. Okay, so thereby lot of people what they were doing, I will not convert, since I have MAT credit I will still be in the old regime, I will exhaust all the MAT credit and then come to new regime. Now to plug those kind of people or discourage those kind of people to voluntarily come to new regime, they brought in this threshold limit of 25%. Okay, so this 25% is something that now encouraging those people who have not migrated because of MAT credit being available, now they will be pushed to new regime, or people who are still not converted, they wanted to come to new regime. Slowly they are putting whether it is individual or non-individual, and they want to reduce the litigations and all of that without any exemptions, without any tax holidays or without any kind of further verifications or any deductions, and that is how they are putting in people into new regime. Another change is from current year onwards, if somebody is still continuing in old regime and if they are enjoying tax holidays, the tax rate that they have to pay is not 18.5%. The MAT rate in Finance Act 26 has been reduced to 14%. So you have to pay only 14%. Unlike earlier it was 18.5 and it is now reduced to 14%. These are the two changes in terms of MAT credit utilization of the computation that will have an impact in the current year while you are filing your returns. Okay, this is just a quick summary of whatever we have discussed till now. Revised return deadline, Income Tax Act 1961, revised return old position was 31st December. In the new position, that is in the Finance Act 26, it has got changed to 31st March. Is it December?
For AMT or only for MAT?
Only for MAT. AMT, I don't see many people are having that kind of blockage or any kind of impact. AMT is I've never, very practically that is not in enforcement. Then in 2025 also same thing. Instead of using 31st December and 31st March, the words used is 9 months from the end of the tax year and 12 months from the end of the tax year. Okay. Here in 1961 they are telling December and March, but there both are same. In 25 the wordings used is 9 months from the end of the tax year and 12 months from the end of the tax year. Fee for filing revised return, earlier it was nil, now it will become 1000 or 5000 because of new section introduced as per old act, it was 234I. Okay, like 234F, now they have brought in 234I for late fee or additional fee on revised return. Loss reduction, ITRU for loss reduction, earlier it was not permitted, now it is permitted. ITRU in response to 148 notice, not permitted earlier, now permitted with additional payment of 10% premium. Non-audit business due date has been changed from 31st July to 31st August. MAT credit in new regime, earlier in new regime you could have claimed without any restriction, now permitted but capped at 25%. one more thing in summary, the rate has been reduced from 18.5% to 14%. This is just a quick summary of whatever we have spent in the last 1 hour. Are we good till here? Anything to pause and discuss or anything to add from anybody? Now we'll get into the changes and forms that we'll discuss in terms of the actual disclosure changes, wording changes, what are the other impacts. Okay. No doubts on this? Are we clear on all these significant impacts? These are also relevant for our ITR filing, that is I have covered this. Otherwise, if we are still simply covering the ITR forums, these are also technically important changes that will impact my ITR filing.
Unordered business due date will cover what kind of cases?
4480 cases.
Any professional income?
Professional income, 4480 cases. Or
Speculation income.
other than 4480, even if they want to go for regular thing, that is possible. With books of accounts, if they are also maintained. Regular small business, small businesses. But that is not applicable for companies or partnership firms. That is only applicable for individuals to whom ITR 3 and 4 is applicable. So this is again a quick thing. Here we discussed one of the points here on updated return reform. And then we have Finance Act number 2 2024 had this 23rd July, because Finance Act 2024 was on 23rd July 2024, and some changes in capital gains was brought in on 23rd July 2024. So certain disclosures with respect to capital gains up to 23rd July and after 23rd July was the bifurcation that was applicable in the previous forms. That might not be applicable in the current year form. In 25-26 there is no need to have that bifurcation. And this updated return reform now will have this additional tax column for paying 10% premium. And some linkages have been done very in terms of taking PAN, Aadhaar, in terms of various situations, then filing revised return. All of these are something which is the summary that is there. We'll quickly see. So this is the quick map of ITR forms. Visible? Not visible. Okay, so ITR 1. ITR 1 is applicable to resident individuals who is having only salary income, house property income, other sources. This was the common thing that we are aware of, correct? But the recent year, they have also told, earlier we are telling one house property, now they have increased that one house property to two house properties. So even if an individual means resident individual, not non-resident, okay? Resident individual having salary income and also having two houses now can opt for ITR 1 and other sources. And earlier LTCG, if it was less than 1.25 lakhs, then they should have disclosed that exempt income under ITR 3 now or ITR 2. Now, if it is less than 1.25 lakhs, those people also can opt for ITR 1. Agriculture income less than 5,000. So this is the condition for ITR 1. And total income should be less than 50 lakhs. Otherwise, I think this now will get changed to 1 crore, but they have not changed or linked in that ITR 1 specifically. Earlier, the disclosure or the requirement of disclosing the assets and liabilities is increased to 1 crore. But in the ITR forum, it still remains 50 lakhs. There is a mismatch, but they might have to change. As of now, 50 lakhs remains.
That is income, that is assets.
Correct. This is total income. That is again assets and liabilities. But disclosure, see, the logic is disclosure of assets and liabilities is required. The linkage is with total income only. So assets and liabilities, Schedule A is applicable if my total income is more than 50 lakhs. So if I go and file ITR 1, Schedule A only is not there in ITR 1. So if I have 70 lakhs of salary, I would have filed ITR 1. Technically, I should have filed or disclosed assets and liabilities, but there is no provision to file. Now they brought that connect or validation to avoid people misusing this. Then they will only tell, why did you allow ITR 1? So you allowed, I filed. You should have not allowed, then I would have gone to ITR 2 and disclosed or ITR 3 and disclosed. So to avoid that, they brought in that validation check. So it is total income less than 50. But last year, for financial year 24-25, the threshold limit for assets and liabilities has increased to 1 crore. But they could have changed that year, that has not happened. So this is on ITR 1. Now ITR 2 is for all kinds of individuals, resident individual, non-resident individuals, HUF, and whether you have capital gain more than 1.25 lakhs, whether you have more than 4 houses, 2 houses, 3 houses, 5 houses, whether you have agricultural income, whatever is the case, all of it is covered except for business income. Okay, all 4 heads of income for all kinds of residential person, ITR 2 is applicable, except for you should not have any business or professional income. So thereby it means all capital gains, foreign assets, multiple house property, whether he is a director, unlisted shares, all of this. And also now when we say director, ITR 1 is not applicable if an individual is director in a company. That is also a negation clause. Then you have ITR 3. ITR 3 is coming for again individuals and HUFs. Whatever is applicable with ITR 2, but if you have business income, you could not have filed ITR 2. Now if you have business income, come to ITR 2. That's all, simple. ITR 4 for those people who are opting for presumptive taxation, 44AD, 44AE or 44AE, and this presumptive taxation is available for partnership firms, but not for LLP. Okay, individual, HUF and firms, not for LLP. So again here ITR 4 cannot be filed if income is less than or more than 50 lakhs and if you have more than 2 house properties. That means to say then which form will I find if it is presumptive taxation? ITR 3 allows to offer income under 44AD, 44ADA and 44AE, and in case there you have income of more than 50 lakhs and 2 house properties. Okay. Earlier it was not there, it was only ITR 4 means it is for presumptive. So now they have incorporated the presumptive based disclosure also in ITR 3. So ITR 4 is only applicable for small business and professional persons where their income is less than 50 lakhs and they don't have any house property more than 2 house properties. Then ITR 5 is for firms, LLPs, AOP, BOI, local authorities, any investment funds, special investment vehicles or business trusts, for all of them ITR 5 will come. And you will have a status drop down with sub-status with which you will have to select and then find. Like AOP with regular tax, AOP, maximum marginal rate, all those different variations. Trust which is not registered, that is considered as AOP, all of that will come in ITR 5. Because ITR 7 allows only registered trust. Okay? An unregistered trust or a trust which is not authorized or does not have recognition under income tax or is not registered, then it will go under ITR 5. Then ITR 6 for companies other than Section 11 companies or like Section 11 exempt entity. What is Section 11? Companies. Section 11 exempt entity. That means Section 8 companies. Section 11 as per Income Tax Act. Section 8 as per Companies Act. Section 8 companies, a company is also allowed to do charitable activities or a non-profit organization. Thereby, company means always we think ITR 6 because we don't have any other returns. We think 7 is for trust. But a company which is an NPO or a Section 8 company will be required to file ITR 7 and not ITR 6. Okay? And that is how it is in terms of the return filing categories. ITRU, updated return, section 139(8)A we discussed within 48 months, earlier it was 24. And ITRV is acknowledgement, the immediate communication that you get that you have filed the return. This is a quick recap. Any doubts on this before we proceed? Anybody have any practical challenges in selecting the ITRs? Which ITR? And good thing is that 1961 and 2025 these form numbers remains the same. As of now they have not brought in any new changes. If they bring something like 2001, like foreign 1040, 1041, 1042, something like that. If they bring 5060, 5070, something like that, we don't know. As of now this remains same. So it should continue to remain 1 to 7. ITR 1, 2, 3, 4, 5, 6, 7. Shall we proceed further? Yes. So let's now I put up in terms of the pointers, the changes and the forums that in which it is getting impacted. Okay. The slide goes, what is the change? This top of the slide that you will see with the Roman number, the summary of the change. To which form it is applicable? The first point will be the form in which these changes applicable. If it is all the forms, then I would have written ITR 1 to 7. If it is ITR 1 to 6, 1 to 6. If it is only 4, ITR 4. If it is 2, 3, 5, 7, then it would be written ITR 2, 3, 5, 7. So instead of repeating ITR wise same points in all three places, I have summarized in the different manner, bucketed into change wise and form wise. Now the change that is brought in here, earlier we had turnover and income for intraday trading was not there. Now for that they brought in two separate line items to report. If I am into intraday trading, that is in terms of share markets or in terms of equity markets where I am doing intraday trading, I was supposed to disclose two different line items. That is, one is with respect to turnover in respect of intraday trading and income, that is profit or loss in respect of intraday trading. Two lines I was supposed to disclose. Now these two lines did not capture or did not have the meaning sync with if somebody is doing futures and options trading also, derivatives. Okay? So nowadays it is common, right? Everybody is in the financial markets, everybody is into equity markets, everybody not only does direct selling and buying of stocks as investment, but also do as intraday trading. Now also keep those equities as underlying asset and also trade with derivatives, futures and options. So there was no place where which we could have disclosed this. There was a confusion. This was shown as other items, other expenses as loss from F&O, or in the P&L other income, profit from F&O. It was shown as a integral part of some P&L item. Okay? So thereby now they have brought in two different line items for futures and options also. Now we need to give similarly how we are giving for intraday trading income, turnover from intraday trading and profit from intraday trading. Similarly now we will have to give two more additional line items, turnover from futures and options trading and profit or income or profit or loss from transactions with respect to futures and options. Okay? So let's read the schedule part A, trading account. This, where does it come? This comes under the schedule A. Now if you have seen if most of us would have been using some software, we will not see these schedules and all, how it is, what is which schedule, which page and which part and all of those. But if you read the PDF or the actual paper return, then you would have been familiar with, how many of you are familiar with these schedules and parts in terms of the paper return?
Only in case of trust.
Only in case of trust. Schedule J, Schedule R is, everything is very clear. Okay, fine. Okay. Probably people who have got some challenges, they would have downloaded, they would have seen paper return or they would have checked in those things. Or sometimes these communications refer the return reference, serial number of part A, OI, something like that, right? Then we would have read. But otherwise, generally, we don't have any need for reading paper return. But anyways, so Schedule Part A, trading account, has this in the ITR form, applies to taxpayers engaged in trading activities, including individual firms and companies. Now this schedule requires the disclosure of key items debited and credited to the statement of profit and loss for the financial year. Now, what is the kind of trading? Trading includes everything, right? Intraday, buying and selling of shares also, that is also trading. Not only buying and selling of goods. Okay, not only buying and selling of commodities in terms of some products that I have built or other products that I am trading, some garment industry or plastic industry or automobile industry or tools and spare parts. It need not be only those, right? It can be shares. Shares also will come here, or if it is options and trading, that also will come here. Now, this is where we need to do this in terms of credit. The difference between total sales and cost of goods sold equals gross profit or loss, which is carried forward to the profit and loss account. So this is the key meaning of trading account. And thereby, the new ITR forms have introduced specific line items to report turnover from futures and options trading and income from such trading that is credited to the profit and loss account. So this is a disclosure. I need to have it in the P&L and then I need to give this specific information in the disclosure. Only if I put the information here, it does not get taken to the computation. Okay, so it should form part of my P&L account, and then I have to give the additional information under these two line items. Now, if you see earlier how it was looking, this is the extract from the PDF or the paper return. So this is the serial number 12A. Earlier it was stopping gross profit from business or profession transfer to P&L account. It was stopping at 12. Okay. Then two line items was introduced: 12A, turnover from intraday trading, income from intraday trading, transfer to profit and loss. So these are the two line items which was introduced in the recent past. Up till financial year or the previous year 24-25, it was available. Now from financial year 25-26 or assessment year 26-27, in continuation after 12A, 12B, you have 12C and 12D, turnover from futures and option trading, and income from futures and option trading transfer to P&L. Want to see this? So you have to give this specific information. Now your trading reports, now you'll have to plan. Based on these changes, one activity that you might have to do is go back and then see where all you'll have to build your requirement list adequately and call for those information appropriately in advance. And this is again a challenge, right? If we don't do all these things proactively in the initial stage of getting the information, then what happens? Ignorance wise, we will be not knowing that this is required to be filled. Then on the last date, after July 15th onwards, in the last 15 days when we are filing, then if some error comes, then we will start asking for this. We will not even know for which all cases that error is there. Whenever we file 27th, 5 returns filed, error will come, then we will call them. 30th we will file 2 more returns, then we will get error, we will call them. Then he will tell, I am in Singapore now, I don't have access to email ID, OTPs will not come, then what will we do? Suddenly some people will tell, I sent you the forum and details on 17th of June. Still now what were you doing? You are not asked all these details. See, this confusion should not happen. So thereby, income tax is one problem and mind management and people management is another equally challenging thing that we have to manage in our profession, isn't it? So go back and put your requirement list adequately strong and sufficient and enough, and so that this will become very clear. Yes, sir.
This 12C turnover of options,
Yes.
will it be the premium volume or the underlying value, the gross value of the premium?
Sir, this is again when we discussed with here also, there are two things. Many of us will get confused with the guidance note given for tax audit for the purpose of getting the threshold limit evaluated for the purpose of tax audit applicability. That should not be confused, and that is why we get this doubt whether we should show only the premium or in terms of the net of loss or profit that we need to report here. We need to report the actual value of buy and sell that happens with respect to the option contract. Now in case of futures, it is the full value. Okay. In case of options, it will be only premium. Okay, and we need not net off and then show the turnover here, because then your 12C and 12D will both become same. Okay, so 12D will be your actual loss or profit, that is set off of all the profits and loss of all the contracts will be your 12D, and 12C will be your actual sale value or turnover volume.
Premium or the gross value?
Sir, premium
The
means
gross, see, gross is 100 rupees in whatever the share value. Premium will be only 2 rupees.
that's what I said. If it is options, then it is premium. If it is futures, then you don't have a premium for futures.
Yeah.
You will actually trade on the full value of the underlying asset with small premium of 2 rupees, 3 rupees, whatever it
So
is.
in case only option is being done, then 12D can be more than 12C also.
Should be.
Why should be? It can be.
Sorry, 12C should be more than 12D.
No,
That's
12D can be more than 12C. If it is premium, we have more profit. It can increase. 12D can always, not always, it can be more than 12C also.
Okay, let me try to understand. In what situation we will have 12D more than 12C, sir? Let's say I buy it for 10 rupees and it goes to 1000 rupees.
Yeah.
Okay, 990 is my profit.
Correct.
So 990 is my 20.
Correct.
Let's say I traded only one quantity. Okay, my turnover is 1000, not 10.
But you said premium, though the premium is only 10 rupees, no?
Correct. When I sold, this is turnover. 10 rupees is my cost. 10 rupees is my buying cost. That is my purchase value. Turnover is not the cost that I buy. Turnover is the sale that I do. So when I sell this contract, I sell it for 1000. So my turnover is 1000 and not 10 rupees. So definitely in no case I can sense of where 12D can be more than 12C. So turnover is nothing but the contract that I have sold. I have purchased for 10 rupees, I have sold for 1000 rupees. So my turnover is 1000, not 10 rupees.
And profit is 990.
Profit is 990, that will come in the below column.
In case of sale and buy,
Irrespective. I buy at 1,000, it goes to 10.
I sold option, I sold the 100 rupees. I bought 50 rupees. Then it is a turnover is 50 or 100.
What did you sell, sir? The answer is there in your statement. I sold at 100, I bought at 50. What did I sell?
100.
100. 100 is your turnover. Your loss is 50. So it does not differ, it does not bother whether I first sell and then buy or first buy and then sell. It does not matter. Sell is always sell, buy is always buy. Sell is to be considered for turnover. Simple logic. Whether it is short sell, whether it is long buy, whatever it is, it should be turnover is always the value at which that contract is sold for.
There is a loss and so 6%.
If there is a loss, show 6%.
1480.
Yeah.
That's what we have been doing. I don't know.
We are suggesting maintain books of accounts and show actual loss.
No, if the
Because
loss-
it's an option trading, it is buy and sell and charges, the bank charges, all of that will be very clearly available. The books can be maintained, the records can be maintained. Prepare a P&L balance sheet for that particular activity of segment of option trading or futures. Disclose the actual loss and carry forward, because no rational person would be ready to pay 6% on the turnover when he is actually incurred loss.
If it's not sure, then we implement that. If it's not sure, suppose
See, I have a question. This income from maintaining of race horses, betting and all, it is in other sources 56,
Correct.
right? Whereas they have put this future and options in trading account, that is part of PGBP. So do they consider this not as a speculative business or not as a speculative activity, but maintaining of resources as a speculative activity?
Two things, sir. What is speculative? Explanation when we see the speculative. Of futures and options trading is not speculative. That is clearly defined. So when you put in futures and options, that is not speculative. Intraday trading is speculative in nature. That does not mean it is other source of income. It is still a business. The nature of speculativeness is business only. So speculative business will still come here. Now the second part, the part with respect to where you are discussing about the income or losses or income from winning and maintaining resources. Now that is specifically income from other sources. That is nothing to do with business, and it is always income from other source. There is a specific restriction for carry forward of losses with respect to 4 years, which is similar to speculative business. But there is no challenge of disclosure or the kind of the concept that you are doing. It is not deemed as speculative business. Just because the carry forward time limit given for the losses from resources can be set off only against winnings from resources, and it is carry forward for 4 years. That is independently different, though it is 4 years. And speculative business loss can be set off against the speculative business income. That is also 4 years. This is independent. This is not a business, and this is not other source.
So you are saying speculative intraday trading
Correct.
can be set off, loss from speculative intraday trading can be set off against future and options profit,
No, it cannot be.
but part of the same trading account.
It can be. Both are different heads of income. One is speculative business. There is no possibility or there is no requirement that since it is same head of income, it should be allowed to set off. It is specific to the nature of income categorization. Speculative business is a different categorization. Regular business is a different categorization. There is another category which is called specified business. That is a different category. 35AD category that you do storages, cold storage, chain storage, warehouse, all of that is a different category. So that is a specified business. That has a different logics in which you apply the carry forward of losses. Speculative business is a different logic of 4 years. Regular business is a different logic, that is normal, 8 years. So very clearly it is defined, sir. No confusion. In my view, it is very clear.
In case of option, actually, we have to margin money.
In case of option,
Options, we have to margin money.
correct, the premium.
Premium we have to pay.
Correct.
So that case, already we have to more than 12 years.
The option premium,
Yeah.
it can be, no problem. Correct. It will be, in cases where you have earned so much profit, then your turnover will be more than that. That's what we were discussing, that 100, 10 rupees and 1000. It can. looks like this topic, first point, I don't know how did I put this as first point. At this point is only we are having good interaction. Some telepathy has happened between all the participants and me that this point is required at first. Anyways, any more points? Some of you were asking, I'll repeat again, summarize. This is with respect to disclosure, what is required to be shown here. With respect to your tax audit applicability, with respect to your reporting in P&L is independent. Okay? It does not get triggered. Point number one, there are different things. One is your investment. Now I'll quickly bucket each of this into three categories. When I'm buying and selling equity shares, with an intention of investment mode, short term or long term. Whether if I hold it for more than 1 day, then it is considered short term and not intraday. If I buy and sell on the same day, then it will be considered as intraday. Now if I hold it for even a single day overnight, then it will be considered as capital asset and it will be it needs to be disclosed under the head capital gains as short-term capital gain or loss, or long-term capital gain or loss under income from capital gains. So this is clear if I hold it for more than 1 day or if I hold it for any number of days more than 1 year or whatever it is, long-term or short-term. Yes.
Suppose I was earlier doing as investing, just March 2026, I was doing shares as investment. Now I don't have any stocking, I don't have any equity shares holding as on 31st March 2026. I don't have. All sold off.
Okay.
From 1st April onwards, I want to do business in this.
Okay.
So can I make a transition? Earlier years, the assessment year 26-27, I showed as capital asset, everything capital gains. Now next year, 27-28.
I'll cover it. So that is the fourth variation. I am not categorized in three buckets. I'll come to that as a fourth variation. So what madam is asking is a different thing, not these three categories. We'll come to that. So first variation is understood to everybody very clearly. Capital assets. If I hold it for not within the same day, if I buy and sell, and if it is extended beyond 1 day, then it will be short-term capital asset or long-term capital asset. The next variation is what we are talking about, intraday. Okay. In intraday, you are getting two variations. That is what we are telling in terms of actual stock. That is actual equity share. If you buy and sell, that is called intraday trading and speculative business. Okay. Now, if you go to futures and options, whether you buy and sell same day, whether you buy and sell after the expiry period of 3 months, 6 months, 1 month, whatever it is, whether you sell within buy and sell same day, whether you buy and sell after 1 day or more than 1 day, it does not categorize under capital asset. It is always business, and it is regular business, not specified business. Now this intraday trading, what I referred to the second variation, that is only for shares. Infosys, Reliance, Wipro, whether large cap, mid cap. Now how many of our shares are listed in NSE and BSE, whatever it is, all of those shares if you trade, it is intraday business, speculative business. The gain is speculative gain, the loss is speculative loss. The gain can be taxed accordingly as business income, the loss can be carried forward, and in future it can be set off only against speculative business income. This much is clear. First part is clear. Second part is clear. The third part. Now the third part is intraday or whatever it is derivatives. What we call it as one word is called as derivative. The futures and options both put together is called as derivatives. The derivative trading or buying and selling later within 1 day or beyond 1 day is considered as business income. Always. Now this business income will be shown as regular thing. Now the question is here how to show the turnover. Now, turnover for all the practical purpose will remain same as we understand in all other practical manner. For any other buying and selling, it will remain same for all disclosure what we are discussing in A, B, C, D, whatever it is. Only for the purpose of determining whether that assessee should get his books of accounts audited or not, you go to guidance note given under section 4480, guidance note issued by the Institute of Chartered Accountants of India. When you go and read the turnover, they are specifically given in terms of derivatives. They are also not telling in case of trading. Intraday trading is not covered there. It is covered only derivatives. In case of derivatives, that is options and futures, you will have to see the net values, the gain or loss need to be taken in absolute terms and to be aggregated, and if that aggregate of those net absolute numbers is exceeding more than 10 crore, then tax audit is applicable, otherwise not applicable. We'll forget all those logic and come back and fill as it is for any other business. So that logic need not be confused with filling of turnover here. This is my opinion. But in various cases, people are filling here. Sometimes validation is having some challenge, some schema error. In the initial years, it was there, but in my view, it is not there as of now when you put it in 12C. 12C is just a disclosure and it is not a turnover for the purpose of any validation. Okay, this is a disclosure and not a computation. And that is why I said, even if you show the profit or loss from trading of futures and options in 12D, that is a disclosure and it does not get captured in your computation. It should be captured in your computation of income or heads of income, and there you need to show appropriately. Now coming to the fourth variation, I will come to you. The fourth variation which Madam was talking about, I have classified, then you will have to go to your accounting standard 13 to recheck as to investments held for sale, investments held for business, and accordingly treat it as in terms of the applicability of whether it should be offered under business income or under capital assets. Now, the example given here on hand is, I had shares held as investments, I sold everything on 31st March and there are no investments as on 31st March 2026. Now, on 1st April, my mindset has changed. From today onwards, I am not keeping it on my books, I am not holding it for investment for short term or long term, whatever it is. From today onwards, I do only intraday trading. 930 buy, 330 sell, 930 buy, 330 sell, 930 buy, 330 sell. I am doing only buying and selling. You can always classify, you can maintain your books of accounts. It is with the assessee how we will classify it. Whereas you can substantiate and establish that it is business and you can show it under business. Now, even if he wants to do business of keeping it on stock for 5 days and then sell it to somebody, with regulations applicable, he is not allowed to do so. He is not a broker. If he is allowed to do so, or if he is doing it on an unlisted stock, he can do so, then that will be considered as business. And it can be continued to show under business income, need not show under capital gains. If you are engaged in the activity of buying of unlisted shares or listed shares and then selling it to somebody off the records, off market, allowed, you can do it as business, not an issue. Need not be shown as capital assets or short-term capital gain or capital loss.
Listed shares only buying and selling, holding for 5 days. I mean, so it can't be business.
It can't be? It can be business. It can be business.
May not be unlisted, it can be listed.
Both I am telling. I am giving both variation. I am not telling only for unlisted. I am telling including unlisted, listed, both. Even if you hold for 5 days and sell, you can classify that activity as business. I formed an entity only for the purpose of getting the arbitrage profits of these fluctuations in the share market. This is my activity, this is my objective. Then it can be always business.
And one more thing, below this table in the software, I think there is a tick mark transfer to computation. Below this table, as far as I remember, there is a tick mark in the softwares which we use, not the regular schema.
Correct.
There is a tick mark saying transfer to computation. So we are transferring this details to the computation.
It is just a convenience given in the way how we are filling the data. Whether it is coming from computation to disclosure or disclosure to computation.
No, because you know the turnover will not.
It is convenience, madam. If this information wants to come to computation, tick it. That is not an imposition given by ITR forms. It is a convenience given by software. So, otherwise you will go and fill in the P&L account. Correct. You will put it in the. So you will go to the P&L and fill all the details, and then it will come to your computation under the income from business or profession. Okay, so that is how it is. The trading, when you do that disclosure, that is how it needs to be done. The moment you fill here, it does not capture in your computation automatically. You have to fill in the computation. And thereby, conveniently, the software people have given, if you want to capture this in computation, tick it. That does not mean this information should go there and that is the correct information there. This is a disclosure. Validation rules are very clear. That's what I am trying to tell. This information is not captured for triggering any non-compliance under 4480 in my view. This is just a disclosure. What you fill in your P&L is important. Both in terms of profit should match. Turnover can be different.
There is a schedule called nature of business. There if you put trading and you can always put it in accounting policy and put as nature of business.
Correct. Nature of trading is now given for futures and options also as a separate class of table, which you can put it there as well.
So even if you have stock as a 20% off, that stock can be converted, right?
converted to what, sir?
That's okay.
Yes.
So there is not provision that sort of amount.
Correct. Even if you have, you can convert it, no problem. Then you'll have to pay, the capital gain computation will be freezed on the date of conversion, and then capital gain computed will remain same. As and when you sell your stock, you will pay both tax on capital gains and the profit or loss under the PGBP. For the difference between the conversion date as cost and the sell date will become your profit or loss. Yes, sir.
What is the difference when you are saying between a short-term capital and the business income? As you say, like if you are holding some stock for just 5 years and I'm selling, then you are saying it's a business.
Intent. My objective. My objective is to do trading and enjoy the fluctuations of the profits. I am sitting day in, day out, doing only buying and selling of stocks. That is my business. If my objective is to do that, then it is business. You are a full-time salaried person working somewhere in an IT tech park or any other company or some MNC. You are buying it, just buying and keeping it. You don't have an intent to make profit as a business. Though you might end up making profit, that will be taxed as capital gain as per income tax. But your intent is not to do that as a business.
So how is that intent captured in terms of, it's just a mindset. And let's say I'm doing a swing trader. I'm not a regular worker or I'm not a salaried guy. I'm just a consultant. And if I'm doing that, how is that, whether I need to consider that as a short
You can do a benefit analysis, sir, whichever is benefit you can take.
Yeah, so that's it. So we can, it's up to me, right?
It's up to you, as long as when I say you'll have to prove or you'll have to say that it is your objective. Once you say that is your objective, it is something that
Is it like
somebody else have to prove that it is not your objective. They should also have some
does
points.
it go by the number of transactions
No,
as
no,
intent?
no.
It's circular also. But if you go by profit, then every year it may change.
If it is 10 crores, 8 crores,
But ma'am, if you are buying MRF shares, your turnover will become very huge. If you are buying S Bank shares, your turnover will not become huge. That does not characterize by volume or by value or the turnover. It always goes with the intent and the substance. You will have to test your substance underneath, not test the dialogues and statements.
then you have to fight basically,
Not fight. You will have to fight. You will have to be clear on your intent. And very clear. Again, objective is more clear. Should be clearer rather than taking and leverage with respect to the law.
Can we get the year-to-year between this one year we get short-term, long-term, another year we take business, then do it like that?
Can be done, sir. As long as you have you are a full-time trader for 4 years. After that, you burnt your hands very badly. Now you want to be investment. You can become. After that, you feel I have got some kind of inspiration or experience. Then I will do trading again. After 3 more years, you can start your trading again.
Can I have both short-term capital gain as well as a business income? Some of the transaction which I
Yes.
want to show
Yes.
business and
Yes. Yes.
if business,
You have to maintain a very proper books of accounts to ensure that what is categorized as business and what is categorized as capital gains, and not always loss is taken as business loss and profit is taken as capital gains. Okay? It cannot be cherry picking.
So if I have categorized as business, everything as business, and I have intraday loss, suppose I have intraday loss, so can I set it off against?
Speculative loss is very clear that it can be taken only under speculative business gain. Your regular business cannot be taken. No.
Can we treat the intraday business as a regular business? Because
If I am
No.
thinking entire thing
doing
as
that
business,
without delivering doing every day from morning to till evening, I say that it's my business. Can we treat it as a business?
If you are classified as business, usually all these things happens in case of broker or in case of trader who has a registered entity who does all these things. As an individual, it will become very difficult to categorize and substantiate and establish the stance taken.
In that case, the loss in the trading intraday, we can set it off against other business.
Correct. That is the anomaly that exists. That's what I'm trying to tell. When you have a legal establishment to substantiate and state that your intended business is to trade, then okay. Ideally, in my view, nobody will establish an entity to trade unless he is a business person or a broker. Okay? That is what I'm trying to say. Intent and substance over form. Okay? Just because to play with the rules or play with the provisions, I can classify here and there, I can act as a man, I can act as an actor, I can act as a child accountant, I can act as a baby, I can do anything. Just because I am acting as a baby, nobody will tell I am a baby, right? I am still a grown up old person. Fine. So I think we have spent sufficient time on this point. We will proceed to the next point. Though it was not on this day's topic to discuss on this part. Anyways, we have got bonus for today's session. Next thing, disclosure of interest and remuneration due or received from the partnership firm. So this is having an impact in ITR 3, ITR 5 and ITR 6. Okay. If you could see where this information will come, this is schedule IF. Okay. Income from firm, or IF is the abbreviation for that. Information regarding partnership firms in which you are a partner. Okay. So then, in the ITR forms applies to individuals and entities who are partners in one or more partnership firm. So that is why it is coming in ITR 6 also. Private limited can be a partner in any other partnership firm. Thereby, ITR 6 also has this disclosure during the relevant financial year. This schedule is intended to capture key information about the assessee's interest in such firms and to ensure proper disclosure of profit sharing and capital contributions. All this while we know name of the partnership firm, plan of the partnership firm, and then you will say what is the profit sharing ratio, and then you will say when you have admitted into this or when you have resigned, and what is the closing balance of the capital. And if you also got the closing capital, then you put that closing capital balance as of 31st March. You will disclose this as the balance sheet item or the status quo. Now they are asking to disclose the interest and remuneration received due or due. So the words used is due. Whether you have received it or not, if you hit the capital account in the partnership firm to the credit of the partner's capital account, then you will have to show here, though you have received it or not, and then you will have to take it. Now, probably one of the linkage and leeway that we could see here is in terms of the TDS compliance. The partnership firm can get triggered when a partner discloses this information. If the information with respect to TDS is not compliant, then TDS authorities can go back of these kind of instances. That is one thing. Dissolution will directly trigger. Correct. First, that's all. To get that information, they are going with the TDS. The TDS means directly it is non-compliant with TDS and disallowance. The ITR forms notified for assessment year 26-27 introduced the following additional reporting requirements. That is amount of interest due or received from the partnership firm and amount of remuneration due or received from the partnership firm. Now, if you see the two tables or the two things that is there, one is the earlier form. First is name of the firm, PAN of the firm. Whether the firm is liable to audit or not, yes or no, we'll tell yes or no. Whether the firm is liable for any transfer pricing audit under section 92E, yes or no. Then percentage share in the profit of the firm, that also we give, whether 50%, 20%, 30%. Amount of share of profit, so this also we give, this is for exempt income, this is not taxable. And then closing balance of the capital as on 31st. This was there earlier. Now if you see, in between these two, there are two more new columns that is coming in. Amount of interest due or received and amount of remuneration due or received. So this will now explicitly gets captured in the schedule IF.
What if it is due 1 year received and next year?
In the year which you have due, if you have disclosed, that is sufficient. That is fine. Accrual basis if you are following, that is fine. So accrual includes received. The same thing you cannot tax it twice or disclose twice. Okay, any questions here? Nothing to discuss here. Now I am surprised. I am left in a no man's island with so many questions on point number 1 and point number 2, no questions.
3 days?
Yes.
3 days. Interest on capital and remuneration.
Didn't get you, sir. Interest on capital?
And remuneration interest on partner. There is a section
184D, correct. TDS. What is the question, sir? TDS, correct. Understood.
Every month or end of the year?
Every month, sir. If you are
Maybe yearly also. Why?
correct. If you are taking salary every month, if you are taking interest every month, if your partnership firm says interest on capital is accrued and due and payable on the monthly closing balances, then how can you say I am taking yearly, then will do yearly? It all depends upon your partnership deal, and if you are taking monthly, the TDS should be deducted monthly. If you are taking yearly, then it should be yearly, no problem. Now we have other challenges also in 180/40, but how do we determine and ascertain? First of all, they have a very low threshold limit of 20,000 rupees. For what is that sufficient? Not at all sufficient. One day's partner's salary or partner's remuneration of that benefit is more than 20,000 in certain cases. So that limit itself is not sufficient.
What the salary pay is what sort of
40B.
Yes.
TDS is paying on the entire amount.
Correct. That's another point of challenge which I wanted to discuss. Yes. So if there's nothing to do with 40B allowability, the TDS has to be paid on the salary paid. You are allowed, the salary is 12 lakhs as per computation, but you are paid 18 lakhs. Do TDS on 18 lakhs. And your computation met 12 lakhs will be allowed, 18 lakhs means difference of 6 lakhs will get disallowed. Now, the challenge is when you have to show this income in the partner's individual computation, you would have got a TDS in Form 26 years on 18 lakhs. On 18 lakhs, only 6 lakhs is something which is not taxable because tax is paid by the partnership firm. Only 12 lakhs is subject to tax. So thereby, one practical solution is that the partnership firm can file these transactions in two different line items. Show 12 lakhs in one separate line item, 6 lakhs in separate line item, and report your TDS in the TDS return separately so that it can be identifiable and that TDS can be claimed. You will be allowed to claim both 1.8 lakhs of TDS, but only at the in terms of any adjudication or any kind of review or any assessment happens, it will be clear to showcase. Even if it is not there, it can be showcased, but at least one level of intent can be established at the time of tax return or TDS return filing itself. One practical solution, and we'll have to see how. Probably in future they might get to put this information separately at the individual level. We don't know. As of now, this is the thing.
Can revise the ETS. Last quarter TDS. Last quarter ETS we can revise it and we can
Yes.
stick with the 40B.
Correct. So the other thing is, I have to do TDS as on 31st month, but in most of the scenarios, the books of accounts gets closed and audited in July, August, September, and the quantification of partners' remuneration in many cases dependent upon the books finalization. So as on 31st March, I am not able to ascertain what is salary itself. In that case, ideally, I have to estimate what could be the salary, and I have to deduct the TDS and remit the TDS, file the TDS return, and then on actual computation, if required, I have to revise the return. As of today, that is the norm and requirement on a practical scenario basis. Because otherwise, when your partnership firm is subject to tax audit, then if you have not done TDS compliance properly, again in clause 34 when you report, and it will trigger a disclosure in clause 21B, and it will get disallowed under section 40A with respect to 30% for the purpose to the extent of where the TDS is not done. So to avoid that, obviously we'll have to revise our TDS returns and then gross it up or level it up to the extent of what is actual expense and claim accordingly. So in most of the cases, I don't see, or in very rare cases, this 12 lakh, 18 lakh example will come. They will change the books only to the extent of 12 lakhs so that there is no difference between 18 and 12, or they debit the P&L only to the extent of 12 lakhs, the allowable remuneration. So that is how it has been practically 99% followed, but in certain cases this exists. It has to be handled in this fashion. So that is the practical challenge.
Instead of TDS applicable if it's monthly salary being low, but can it be taken as an advance or a loan and then settled at the year end?
Yes, sir. The people are doing it as long as you are debiting your capital account and not debiting your P&L account. Your P&L capital account can continue to remain debit balance. No TDS can be attracted on the capital account having debit balance. And in the P&L account, unless you have not debited, it can be. We don't know. They might get a new loss. We don't know. All this, after hearing all these things, they can tell to the extent of credit balance you can claim. If it is after credit balance, then pay TDS. They can get a new clause. They don't know.
Yeah, because since it is not ascertained till the end of the year because of the quantification just now that you mentioned.
Correct.
Can this practice be followed? Right?
It can be followed. That's what I'm trying to tell you. You can not ascertainable versus not remuneration at all. I cannot, I'll have to estimate, and I am probably, instead of taking it monthly, at least on March I should be able to establish. So April to February you can follow, but if you have taken money, then you will have to do TDS monthly. You cannot get that excuse of not ascertainable, so I am taking 1 lakh every month, so in March I will estimate and pay TDS in March, not possible. Every month I am drawing money, then that is your remuneration. Unless you have debited your capital account.
Money gets drawn to capital account.
If that's all. Method of account.
But drawing as a loan or as an advance?
That's what I'm trying to tell you. If you have not debited your salary account, if you have paid, let's say you are running a salary register, in salary register your name is there, your salary is there, you are drawing along with salary, and then you are debiting your capital account, still permissible, no problem. Nobody can question that it is a remuneration. But as long as you have debited your capital account, TDS might not get triggered, mind you. The moment you debit P&L account, you will have to take TDS. So, like I said, the other variant of it is every month I am drawing 1 lakh and debiting capital account. And on March, I am ascertaining, estimated, and I am taking all these things and I am crediting salary to capital account. And take remuneration, into TDS in March, no problem, allowed. fine. Let him put within the framework of the current permissible interpretation.
Remuneration is showing what we need.
It is a topic for different day. If I get into that, then we will not finish this. I will reserve that. After the session, we can discuss, not an issue.
Capital account include current account also.
Yes. Account can be on asset side also, need not be on capital account current account. The moment it has debit balance, it is classified as an asset account, not a liability account, so it can be balance sheet anywhere. Any more creativities on partners remuneration? Okay, let's move. This is just disclosure perspective, so we should be more clear in terms of we are disclosing this.
So, another thing, so in partner's capital account, suppose you are crediting 1 lakh every month remuneration.
You cannot tell remuneration. If you are crediting capital account, it is a capital account transaction. You are withdrawing your capital.
Yeah, you are doing debit credit both. Okay, some amount.
That is like additional capital introduced, capital withdrawn.
Maybe drawings, whatever.
Drawings, whatever.
Sir, now when you calculate interest on capital, which balance you should take?
As defined in your partnership plan.
Interest on capital is only one clause is there in the partnership. It cannot exceed 12%.
That's all.
No, that is fine. I'm saying when you calculate on a day-wise basis, suppose I had capital, partner had credit balance of 1 crore, then he deposited 10 lakh, withdraw 5 lakh.
It will be on the running balance, very simple.
No. So interest will be calculated once giving this debit credit entry, full effect,
yes.
Net.
Yes.
Product basis.
No,
Product basis.
on a daily basis.
Yes. Daily running balance, you calculate interest. I'm not sure if I got it right. I did not get the ambiguity. What is if I have not understood the question? So it is on the running balance of the partner's capital account after netting off both the debits and credits, interest on capital. Many people have interest on capital defined very variously in the capital partnership agreement, telling that it is only on the current account transaction, not on the capital account transaction, regular transaction, not business expenditure, or only it should be nominated exclusively as capital transaction with respect to introduction of capital and withdrawal of capital. So there is a variation. That's why I said it depends upon the how it is drafted in the partnership deed. Okay. Let's go to the next one. The third one is name and PAN of the political party to be disclosed under Schedule 80GGC. Okay. 80GGC. What is 80GGC? Contribution to political parties by corporates. Okay, so 80GGC or 80GGC is for political contribution. Thereby, what are they asking now? Earlier they asked for transaction reference number and all of those. Now we'll have to give name and PAN also. If you see here very clearly 80GGC, details of contribution made to political parties. The first one is date on which you have made, contribution in cash, contribution in other mode, total contribution. That is a subcategory in the amount of contribution. Then you have eligible amount of contribution, and then you have transaction reference number for UPI transfer or check number or IMPS or NEFT or RTGS, and then IFSC code of the bank. Now here there are a lot of challenges again. Which IFSC code I have to give, whether my bank of IFSC code or the IFSC code of the bank to which I have transferred, which transaction reference I have to give. All of this was the confusion, but anyways it was there as it is. Now you will also have to give the name of the political party and the PAN of the political party. Day by day they are increasing. Earlier it was only till eligible amount of contribution. Earlier it was only date and contribution, and then it came eligible amount. Then you got transaction reference number. Then you got IFSC code. Now it is name of the political party and PAN of the political party. Okay. Next is, this is again very interesting change. The fourth change that we are discussing is applicable in ITR 4. Additional disclosure for presumptive income taxpayers. We were disclosing cash, debtors, creditors, stock, 4 important things, and there were many others, advances, assets and all of those. In that, there was no line item called investments made. Now they have given a new line item in that schedule financial particulars, investments made also required to be disclosed. The new column has been introduced in ITR 4 under the head financial particulars of the business, requiring disclosure of the amount of investments made by the assessee. This marks an additional reporting requirement for taxpayers opting for presumptive taxation scheme where otherwise detailed financial disclosures are minimal. Okay. So this is how it was there earlier, E11 to E25. Okay. These are the information to be disclosed. This is the last year form, that is why it is put as 31st March 2025. Now if you see this year, 31st March 2026, E11 to 25 remains the same. 18A is introduced, investments made. Okay. Investments made should be disclosed in the...
So investment only in this particular year or cumulative?
You have to read the circular in terms of the what is the intent, sir. In my view, it should be balance sheet as on.
Cumulative.
Cumulative.
What could be the purpose of introducing this?
They might be seeing the kind of income that we are offering versus the kind of investments getting accumulated or the assets that are there with the assessee versus the income offered. Could be possible. Whether they will immediately bounce on, we don't know. When they might come back, they are collecting the data. There are many data they are collecting, we don't know the intent, sir. Like clause 44, GST and bifurcation, for what reason they are asking in tax audit, we don't know.
Income may be 20 lakhs per year. Investment may be 5 crore accumulated, then they will put it.
No, they will not put. Even if they put, if you have proper source explainable, for last 20 years they have accumulated, no problem. In 1 year I have accumulated, there is a problem. Here it should be personal, sir, or there is no clarity here. It can be personal or business. How do we determine? Investments is always in personal nature. How do we say it is business investments?
First of all, we don't maintain books of accounts if you are coming under business.
That is the next point I was coming.
These very details.
The moment we give all this information, it becomes that we are maintaining books of accounts. But I go with another logic that for GST purpose, books of accounts are different. The moment we have all those things for income tax, we cannot say there is no books of accounts. The purchase register is there, the sales register is there, invoice register is there, and all the expenses, indirect expenses, administrative expenses, overheads, marketing, everything, there is GST R2B that has come into picture. Indirectly, there is already books of accounts exist. In today's world, once it is digitalized, we cannot claim anywhere in any manner to state that the information is not available. Probably I might not have maintained in the mode and manner in which everybody regularly maintains in a software called Tally, Zoho or QuickBooks, but information is already available in the form of bank statement, purchase register, sales register, GST R1, GST R2B and many other information which can be consolidated into one software and it can give you books of accounts in whichever format you want. So today, books of accounts not maintained, there is a notion that we have in our mind. Parallelly, there is books of accounts exist. We are not able to see it. That's how I would like to see it.
The mandatory field to be entered because
here we have only 4 information earlier. Now also that 4 will continue as mandatory. This will remain as an optional. We will have to see.
Does investment means only shares, securities,
any investment, everything. It can be real estate, it can be gold, it can be shares, it can be PF, PPF, mutual fund.
It's just a number we have. Total number.
It's the total investment number we have to put in there. Okay, we'll proceed to next one. Next is now reporting under presumptive scheme or ITR 4 is extended to non-residents also with respect to where non-residents are allowed to offer their income under a presumptive basis. Under section 44B, 44BB, BBA, BBC, BBD, these sections are applicable to non-residents. These people were supposed to file ITR 3 earlier. Now that was not required. They also show some shipping business 7.5%. Something like that, right? And all those people, only 2 information, ITR 3. Instead of that, they can put ITR 4. They have introduced all these section numbers in ITR 4. So Schedule Part A, P&L, General Profit and Loss Account in the ITR form captures details of the taxpayer's financial year profit and loss statement. So this schedule applies to taxpayers who maintain books of accounts and is especially relevant to those engaged in business or professional activities. So in case the regular books of accounts for business or professions are not maintained, the taxpayers are required to provide only information under the case where no account case and give only turnover and the deemed profit. Correct? So that thing will come here. So here, if you had seen earlier, this after 65 nothing was there. Now they have introduced serial number 66 in Part A P&L account. Okay. So what they are telling in case of non-resident, if the total income comprises of profits and gains from business referred to in section 44B, BB, BBA, BBC, furnish the following information: gross turnover, net profit. Similar kind of thing. Okay, so this is.
What is the tolerance of the strike at 5? The previous slide is
in 3 and 5. Then partnership firm engaged into these kind of business. they can also show in ITR. Okay. The next thing is removal of fields reporting of foreign retirement account from ITR 1 and ITR 4. This is just a cost alignment with the thing. What has happened is earlier they were required to show foreign assets. See, if anything that I am withdrawing from a foreign account, like 401k account or some PF account or pension, social welfare accounts in the foreign countries, if I have to withdraw that, earlier it was supposed to be shown in ITR 1. Now, since it is considered as foreign assets, now if I have foreign assets, I cannot file ITR 1 itself, I have to file ITR 2. Thereby, it does not make sense to have these information in ITR 1. They have been done away with those disclosures. Earlier it was showing income from other sources. In the drop down, you will get interest from savings account deposits to be provided in the e-filing utility, and in case of dividend, income from retirement benefit was there. Now, if you see in the drop down, that will not come in the income from other sources. So this is just alignment with respect to the changes that have happened in terms of disclosure and applicability of the form itself. So those who are having foreign assets, they might not be required to file this ITR 1 itself, or not permitted to file ITR 1 itself. Next thing, in terms of auditor details, earlier in Part A general, in case of ITR 3, 5, 6 and 7, we were supposed to give all these details. Date of furnishing audit report, name of the auditor signing the tax audit report, membership number of the auditor, name of the auditor or proprietorship or firm, then proprietorship firm registration number, PAN or Aadhaar of the auditor, okay, and date of audit report, acknowledgement number of the audit report, and due date. These many details are required to be given in terms of the auditor. Now it is reduced to only 4. You will have to give only date of furnishing of the audit report, acknowledgement number of the audit report, name of the auditor, PAN of the proprietor. I don't know, they removed UDIN also. I don't know if UDIN is not required, probably they are validating at the back end. It is already validated, so there is no requirement to put it again. Most of the times UDIN you are not able to generate then. You have a time period and time frame later to generate. So UDIN is not required. Now if you see here, name of the auditor they are not asking, but name of the auditor or proprietorship or firm is there. So if it is a firm, then if you give firm, is sufficient. You need not give the name of the auditor. If it is individual, then you have to give the name of the individual. Proprietorship or firm registration number is now not required. PAN or Aadhaar number of the auditor is not required now. UDIN is not required. So what is required is only date of furnishing of the report and acknowledgement number, name, and the PAN or proprietorship of the firm. That's all. So earlier you see here in the Part A general, if yes, that means if your whether the accounts have been audited by an accountant, if yes, fill all these things. You see here, it starts from 1, 2, 3, 4, 5, 6, 7, 8, 9, stops till UDIN. All 9 details were there earlier. Now if you see the form, it is very clearly only 4 line items. Okay, so only specific. So there is some kind of fields that organization that they have done as of now. Okay, then this is again, we have already discussed this, nothing much critical or technical in this. Earlier we were supposed to show 23rd July before and after. Now that bifurcation is not required because it is not making any sense for 25-26, that has been removed. Then again, this is again similar to that, BBS buyback of shares schedule was there, where ITR 6, the companies were required to give details of shares bought back by them because it was an exempt income and companies were paying tax on that buyback of shares, and it was exempt under section 1034A. Okay, since that taxation regime has got changed, no more companies is required to pay tax. Individual is now required to pay tax on that. Thereby, the disclosure by company of how much buyback is done of shares and that information is now being done away. Okay. Now coming to some of the changes with ITR 7, where you have to give the reporting of substantial contributors under section 13(3)(b). Until last year, there was no clarity in the ITR form when you read. It says only details of substantial contributors. Now we have to read 13(3)(b). It said if somebody has contributed more than 50,000 in a particular, they have not told anything. If more than 50,000, then they will become substantial contributor. Whether during the year, cumulatively 50,000, that clarity was not there. So then they brought in that clarity in the last year, telling that during the year 1 lakh or cumulatively more than 10 lakhs, then that donor will be considered as a substantial contributor. Thereby that clarity or the wordings in the form itself has been changed. Now if you see earlier, name of the person who has or have been substantial contribution to the trust in the terms of section 13(3)(b) during the previous year. That's all. There was no other information or description given here. Now it very clearly gives the description where and how it should be considered for disclosure. It very clearly says whose total contribution to the trust or institution during the year or during the relevant previous year exceeds 1 lakh rupees, or in aggregate up to the end of the relevant previous year exceeds 10 lakh rupees, as the case may be in terms of section 13(3)(d), then only it needs to be disclosed here, otherwise not to be disclosed. So description is given here. Law is already amended, nothing to change, but description is given in the forms. Now again here in terms of Schedule J, in case of ITR 7, you need to make or disclose the total value of investments made by the charitable trust instead of its nominal value. Okay? Earlier it was, the words used were nominal value. Now it is replaced with total value of investment. What is Schedule J? Where is this coming in? I think 2 years back they introduced a lot of schedules in the ITR 7 to reconcile the opening balance, movement of corpus, movement of investments, and the revenue expenditure and capital expenditure, and in terms of the brought forward, unapplied, the time consumed, where you can extend the time limit for application of incomes by finding Form 9, Form 10, all of those, right? So to reconcile all of them, they introduced a lot of statements and schedules. One of them was Schedule J, where you will show statement showing funds and investments as on the last day of the previous year. Now this should get mapped to the assets that you have in the balance sheet, basically. That is what the intent was. In the form ITR 7, requires a statement of funds held as on the last day of the previous year and is applicable to associates claiming exemption under section 11, 12 or under section 1023. So within this schedule, specific disclosure is required in respect of investments held during the previous year in concerns in which persons referred to in section 13(3) or the 21st provision, similar section in 1023C, who is having a substantial interest. Now if you see the form, you will get little better clarity. Now you need to show here where the amount in column 6 exceeds 5% of the capital of the concern during the previous year, tick as applicable yes. So here you are showing nominal value. What is nominal value? It is the cost might be. The intention here, earlier we were thinking that what cost it invested was. Now it is asking total value. I am not sure as to what exactly they are changing in terms of the nomenclature, whether they are intending to ask a fair value, fair market value, or the latest realizable value is something which we will have to evaluate. Only wordings has been changed, but we are not sure of the intent. So it is the broader, typically refers to the face value of the shares or securities, nominal value means. The term total value is broader, capturing the actual investment value rather than just the face value. Now I might have invested at some 70 rupees, now today it might be something more, so we don't know. Or the gold, usually it will be gold, so they will have some investments in X amount. Now the value of that gold is increased, jewelry, ornaments. Now if you see ITR 7, there is, not ITR 7, specified mode, section 11(5) did not have the wordings used gold or jewelry or ornaments, okay? And furniture was not there. Now if somebody contributes a gold chain to trust, okay, I need to invest in a specified mode. If I have to invest in a specified mode, how can I invest? I cannot hold that jewelry as it is. It is a contribution received in kind. Now I cannot go, since it is not a specified mode, I cannot hold it. That means then I have to go out and liquidate it, sell it, then get cash and then put in FD. Is that considered as a specified mode? So there was a practical challenge. In case of schools and colleges, many people are giving furniture, cupboards, almirahs, tables and chairs and all of this. Now if they contributed, I want to use it as it is, right? I cannot go and I cannot tell this contribution is received in kind. Where is it in investments? In investments, it is not there in specified mode. Now, how can I reconcile? So there was a practical challenge. Now they brought in these two things in specified mode definition: gold, jewelry, ornaments in Finance Act 2026 amendment, both in ITA 25 and Income Tax Act 1961. Thereby, these practical challenges are now aligned. Similarly, here now they are looking at actual investment cost. We don't know. In case of gold and jewelry ornament, somebody is contributed. In case of religious trust, in case of many organizations, if the gold is given, it might be very long back, right? 1,000 rupees per gram, 2,000 rupees per gram, 5,000 rupees per gram. Today, 16,000. Are they intending to capture the fair market value as of today? We are not sure. So this is that change. Next change is again with respect to trust, where we need to disclose the registrations that the trust has, whether it is a 12A, whether it is ATG, whether I have a Darpan registration, whether I have FCRA registration, if any other registrations that the trust holds, it needs to disclose all the list of registrations that it has, correct? Now it was asking the details of which law under which that registration is taken, what is the name of the law, date of registration or approval, and who is the authority and what is the approval number, and date from which the registration is effective. Only starting date was asked, okay, from which it is effective. Now they want to capture date up to which the registration is valid. Okay. So now you need to keep date up to which the registration is valid. Now earlier what has happened, now we would already fill this data and it is already saved in our software. Nothing, we were not doing anything in the every year. Now again 1 year now we need to go back and check the approval letters and see till when it is valid. Now practical challenge that might come is Darpan. Darpan is a one-time registration. I don't know if they mentioned the validity, or there can be open-ended registrations. If it is open-ended registration, what will I fill here? With what aspect they are asking, again that could be practical challenge that we might face. For every registration there might not be an end. There is no need that every registration is valid only for 2 years, 3 years, 4 years, 5 years, 10 years. It can be open-ended registration also. When it is open-ended registration, what am I supposed to fill here? And will software schema validation will not allow us to file further if this is not filled. If this is not filled, then practically should I fill some date? This is the challenge that we could face. And this is some cosmetic change. I don't know if it is a cosmetic change or if they are intending something more in future. The objective I am not sure. Earlier we had address field, one address. Okay, we'll give one address. Now they are asking that address is renamed with primary address and they are given an additional field called secondary address. Okay, now they feel that people are having two houses, one in Chennai, one in Mumbai, so they want to say that first decide which is your primary house. If Chennai is primary house, put that Chennai in primary address as Chennai. Mumbai, you put it as secondary address. Or the vis-a-vis the other way around. Most of the employees are now relocated from one city to other city and they have one house in that primary city, in the city where they were born and brought up, and the other city where they are working and living now, they might have two houses, two addresses. Now put up all those addresses here. One other thing, the HRA they might link from this in terms of HRA deduction that they might claim, we don't know what is the intention. The other thing they might have to see in terms of the communications, if they want to catch hold of or if they want to send any communication to any agency, they now have alternative thing. We don't know what are the intentions, but this is what they have been asking for. Also, earlier we had for email ID, primary email ID number 1 and email ID number 2, phone number 1, phone number 2. We had options to fill 2 different email IDs and 2 different phone numbers. Now we have 2 different addresses. So if you see, this is the earlier form, only address is there here. This is the address section where you fill only one address, but you have phone number 1, phone number 2, email address 1, email address 2. Email address 1 was self and email address 2, it can be anybody else. Okay, I can give my friend or I can give income tax officer address also. No problem. Okay, they have not told him. Now, if you see, the form has got changed. It is asking for primary address separately, secondary address separately. Now, email ID number and mobile number 1, that has been renamed to primary mobile number and secondary mobile number, and primary email ID and secondary email ID. Okay. Now it is not of self. Primary, earlier it was self. They specifically mentioned self. Now self word is not there. If somebody wants to literally interpret and give somebody else is also no problem. Communication will go to that person. They should answer it. Any notice goes, any summons or any kind of intimation will go to that number. That's all. Okay, this is another cosmetic change. Rationalization in detail sought in respect of representative assessing. Okay, so earlier 4 details was asked. Permanent account number and Aadhaar number of the representative assessee was asked. Now that is being done away. I don't know what is the reason that they have taken out. Because if you have already, now the e-filing portal itself will link that representative assessee that at the time of filing. So they don't want that. It's something which the practical way of thinking that they might have thought so. The next thing is changes made to incorporate due date extended to 31st August by Finance Act 2026. Now the due dates that are applicable in ITR 3 is people who are filing for July also will be there, September also will be there, sorry, October also will be there, November also will be there. So that earlier it was 31st July, now that date has been changed to 31st August also. Okay. ITR 3 definitely will not be filed before 31st July. Due date is extended to 31st August. Okay, so there won't be any July no more. So that's why 31st August is coming in the latest form. Earlier it was 31st July. So the due date of filing of written off income dropped down in case of ITR 3. This is applicable only in ITR 3, not in ITR 1 and 2. So only in ITR 3 the due date is extended to 31st August. Thereby this change is coming in the picture accordingly. Now 1 more month time will come for your late fee filing. So this is extended. For ITR 3, due date itself is 31st August. So the late fee to 234F will get triggered only from 31st August and not on 31st July. Similarly, like how we saw AT-GGC, now AT-G earlier was asking details of name and PAN. Now it is asking for IFSC and transaction reference number. Okay. So now if you see here, earlier it was asking name and PAN of the trust, the charitable institution to which you are donating, but there was no transaction reference number and IFSC code. Now that is asked for AT-G. In AT-GGC it was reversed. Earlier it was transaction reference number and IFSC code was there, name and PAN was not there, they introduced name and PAN. Here name and PAN was already there, IFSC and IFSC code and transaction reference number was not there, now that is introduced here in the new forms. Okay? This is again, more information is being collected. We should be, that is what I am trying to say, we need to go back and put out on a requirement list, elaborative and exhaustive one to ensure all of this is collected. And we need not put it in our exhaustive list because we customize our requirement list for every SSC, right? And we know every SSC to what kind of category is exposed to and what kind of income and transaction that is trading into it or involved. So accordingly, we can customize the requirement list as well. Next thing is ATGGC. This is again, okay, this is already discussed. We discussed reporting of the fee for furnishing the revised return of income. So this again they have got in 234I. Earlier 234F only was there. Now 234I also is there. If it is Jan to March when you are filing the revised return, then it has to be 5,000 additional or 1,000 additionally. So then automatically your softwares will calculate that and you will be paying that. But this is how the disclosure looks like. Reporting is required for disallowance of MSME interest. So in the disclosure part AOI is, or where is this coming in? Part AOI, other information. In other information, we'll give disallowance under section 43B, disallowance of gratuity, disallowance of all kinds of disallowances. MSME interest was not getting captured, so there was no linking between the tax audit disclosure that they had changed last year and they realized now. Last year it gone, there was no linkage. So this year onwards they want to get that linkage. Now they got it here. So 17, if you see here, interest disallowed under section 23 is coming in here. Earlier this was not there. So 17 was 18 point, now 18 has become, I don't know, they could have put it after 18. 17 can be retained, same 18 could have been inserted later, but in between they have bought in this point. So this is one thing that interest disallowable has come into picture. So these are the major changes that I could observe in terms of the forms that were there, which is applicable for income tax the previous year 25-26, which assessment year 26-27. Any doubts on things that we have covered till now? The next segment will be on some of the common important critical aspects at the time of disclosures where we forget. Already these are there from several years, but we might have taken it very lightly. We'll touch upon 6-7 instances on those aspects in the next segment. But before that, I would like to take a pause here to see if there's any questions.
So if you hold Bitcoin,
yes, sir.
Whether it will come in AL or whether it will come in FA, and if AL is less than 1 crore, then can we do away with reporting of Bitcoin?
So AL is assets and liabilities if you have disclosed in AL. FA, if it is a foreign asset, so how do you determine it as a foreign asset? Because if it is held in a broking agency which is outside India, then it will still get categorized as foreign asset irrespective of assets that you have disclosed. You will have to disclose under FA.
No, I purchased it in an Indian exchange, CoinSwitch Kuber, suppose.
So that is held in Indian exchange. You can keep it in assets and liabilities. It is not a foreign asset.
So need not disclose if it's less than 1 crore.
I need not disclose if it is less than. Okay.
Bitcoin itself is a foreign asset or no?
It is a thin line of difference, sir. Bitcoin does not have any existence where it is lying. It is in the universe of blockchain. First you have to locate where is the server. How do you determine where is the server? Which blockchain is running in which server? Now if it is shares, you can tell it is traded on this exchange. Exchange is located in Mumbai, Bangalore, Ahmedabad or New York, London, China, Taiwan. Blockchain is a universe. So we will not get to know that. There is a thin line of difference. It can, that's what we say, if it is traded through different Indian exchange, then it is held in this DMAT or that KuberX or Coin DCX or whatever these platforms. We can take that. That is one, again, an ambiguity or possible two views that can come in picture.
Because VDA schedule, it's only the income, it is not the holding.
Correct, agree. VDA is only for tax and income. It is not for loss also, and it is not for asset also. Okay, let's proceed then.
Yes.
Okay, looks like all of you are tired, huh? Isn't it? Isn't it? No. People who have not told anything, then it looks like you are tired. That's why you didn't tell anything. Fine. So some of the critical aspects is in terms of details of directorship and unlisted shares. So now in the current last 1 or 2 years, Director is okay, not many of them will be there. So those who are directors, that needs to be disclosed. The details of the company in which an individual is a director, and most of them will disclose. That is something which was not getting disclosed earlier. Now it has become practice that it is getting disclosed. But in terms of unlisted shares, now in the last 1.5 years, there's a lot of craze and a lot of enthusiasm in people who are buying and selling unlisted shares. Okay? As an individual or as an employee or as a taxpayer, he might not know that he is required to disclose. Now it is our duty to inform and ask and question him, have you traded in any unlisted shares? An extra question should be asked. If yes, then ask for those details and disclose the details. What is the company in which you have invested, PAN number of that company, number of shares, date of purchase, and the cost of purchase should be disclosed. And it asks for movement also during the opening balance, during their purchase, during the SCM, closing balance. Okay? So there again you have to disclose accordingly. And here again, if you take their demat account statements, you will find all these things in the demat if it is credited, and the value will be face value. So you cannot disclose at face value, you have to see at what price that they have transacted for. Okay? So that is another challenge. Most of them will take their demat account holding balance, will show only face value, and they disclose only face value. But actually I might not have paid that. Now the challenge is if I disclose only face value, tomorrow when I am taking it for capital gain, now if I sell it for 1,000 rupees tomorrow and then I report 1,000 rupees, the cost might get linked with 1 rupee because it will disclose only 1 rupee of face value. Okay? Give exact cost. If you purchased at 800, put 800 cost here, so that tomorrow when you take actual cost of 800, it might be honored. Otherwise, it might get an anomaly and mismatch. Now, having said this, they are not sure whether why are they collecting this information, when will they integrate the information, and when will they come back and ask any taxpayer. But they have all the facilities, data, abilities to integrate anytime and ask anyone. So, with that intent, we should be careful enough. Next thing is with respect to details of shareholders for unlisted companies. This is where we are discussing of in terms of unlisted companies. Then we need to give the name of the shareholder. This is in terms of company. Okay. In company, we should give the list of shareholders. Okay. We'll have to give the name of the shareholder, residential status in India, type of company, type of share, whether it is equity, CCPS. Now there are multiple fancy shares, right? Preference shares. Convertible preference shares, non-convertible preference shares, cumulative convertible preference shares, debentures, convertible notes, share warrants. Okay, there are multiple kinds of instruments that come into picture. We'll have to take date of allotment, number of shares, face value per share, issue price per share, amount received. All of this needs to be disclosed. Now the information that you show and the company shows will be none. That is what they are trying to say. Now this is for an individual perspective who will show the shares held in an unlisted company. Now this is an unlisted company disclosing its shareholders. So there will be a cross map that happens automatically at the back end if they intend to. The information will be available. Okay, this is again commonly seen thing. Most of them are taking advantage of the cost of improvement. People are paying it. This is again they brought this change with respect to the kind of misuse or the kind of advantage taken. If an asset is, land is taken and construction happens over a period of 4 years, okay, then the year in which I start will be taken as cost of improvement rather than considering the year of improvement, because indexation will start from year of, indexation will be higher when if I consider the year of completion. So assessors were taking only 1 year as year of improvement, and the drop down was also not available to give multiple year information. Now the information is available to give multiple year thing also. Now we'll have to take into consideration accordingly. Now the impact here is not only about the computation and quantification of capital gain, but also there's another way of looking at it in terms of what impact it can have. Now people play around this, not only about year 1 versus year 4. Year 1 if I take, my indexation is less. Year 4 if I take, indexation is more. Now anyways that is done away, you don't have indexation concept, now it is removed. So this cannot happen. But year of the amount of indexation people were putting to reduce the gain, they would have inflated it in whatsoever manner that they want. They feel convenient and appropriate and consider as tax optimization, but it is tax evasion ideally. Because if you are not able to quantify the cost claimed for that particular year, then unexplained income or investments can get triggered for that year. That means to say, if you have claimed instead of 50 lakhs, 75 lakhs as cost, 25 lakhs, where did you get the income from to invest in that year? Let's say actual cost is 50, but you have claimed 75 lakhs as cost of improvement. and they go back to that year and reopen the case as income for unexplained income, telling that you are eligible or your income is giving only so much, but you are able to invest so much. The difference is unexplained income or assets and investment. So this is triggering for that 69 section possibility also is there. So not we think of today's thing, but the future impact can be on account of other assessments of income estimating assessment also. Next thing, ATG. Now we'll have to give the ARN number, but many of them were not able to fetch this data in the last minute last year. This became mandatory last year. But when we went and asked if you have to claim ATG donation, they're giving the receipt, handwritten receipt, but that does not have an ARN number. But ARN number is mandatory to claim the ATG deduction. So let us give them that information now only. We'll tell them that go back to your donor trust, tell them that they are required to file by 31st May and let them give it by June 1st week. Okay, we are in May now. We can ask them to go back and ask for it. They will not get it immediately, they will get it in June because the due date for filing form 10BD is 31st May and 10BE can be generated in the first week of June and they can get it by June. So many practical challenges that we encountered, that this process was not so familiar and common with the taxpayers, and when we went and asked for this information in the last moment, and they say now if it is not in my hands to generate, now I have to go and ask them. Their accounts team, their finance team is very big. By the time they respond, it will take time. And in some cases they went and asked, they said they have not at all filed. Now they are going to file. If they file, then it will take time. They'll have to give it to us. It was taking time, so it is better to take care of this in advance. Then this is in terms of partnership form. We'll have to report the remuneration paid or payable in terms of change in constitution. If there is any change in the partnership form, like admission of partner or retirement of partner, most of the times we forget to make changes in this basic information because the filling data will be done by the junior level staff, and then we know that reconstitution happened. They might not know. Even if they know, they don't know that they should fill it here. We should ask them, then they will fill it. We should tell them, they will get it and they will fill it. So it's all on our part to ensure that things are done in the same way. We cannot go and also get irritated and frustrated on our team telling that you should have filled it. How will they fill it? Until we enable them, they will not fill it. Isn't it? Okay, these are some of the critical aspects. I think I have 5 more minutes probably. This is where the summary. Now we have dual communication block. One is primary plus secondary thing. The summary of whatever we have discussed till now. Representative assessing detail is standardized. Capital gains changes have happened. Section 234 IA has been imported. Okay. 10 IEA is also now, since the old regime, new regime has got changed. The questions asked are changed to ensure that accordingly. Now the old regime was default, and then opting out from old regime to new regime was there. Now new regime is default, opting out of new regime will go to old regime. So to that extent, earlier only they have made changes. Now some more changes have been made in the current year to reflect that decision tree making. Okay. Right. This is where I complete. I'll share the presentation. This is in terms of technical. I have given field-wise what is the change and the reference number A7, A7A, A6A. Okay, so this is where somewhere it is changed. We have discussed all these changes. Somewhere it is same and not same. So ITR-wise also I've compiled. This is what is new and what is old and what has got changed with the Roman number-wise, A7A and all of those. If somebody wants to look into, if this is more easier to look at ITR-wise, because what we discussed was change-wise in whichever ITR it was there. Now this is ITR-wise. This is just tabulated for somebody to look at if there is any need. Okay, this is something which the presentation will be shared. I think they will email it to you and it can be seen. Same thing. Wherever it is changed, or same, unchanged. I have given all the comments here. ITR 5, ITR 6. Okay. So this again, we have what were the reasons with which we could have filed? What are the reasons with which we are not able to file now or enhanced new? So that is also there. We can look into these rates which we saw 25, 50, 60, 70, 35, 60, 70, 80. All of this is again similarly. Okay. So this again, everything is remained same, and it is split into 2 pages now. Acknowledgement. You might start getting 2 pages acknowledgement as we go forward. Okay. So this is some more kind of the conclusion takeaways where you can think of in terms of verify the information in Form 26 AS, AIS and DIS first, and then build your checklist and get more information. I think by May or June everything should get updated by June basically. So you can start getting basic data, validate with AIS and all of this information 26 AS in the month of June, and start asking for gap if there is any gap, details for that gap. Okay, do an analysis. Confirm regime selection before the due date, because you cannot do it after the due date. If you have to go for old regime, opt out before the due date and file it before the due date. Okay. Otherwise, by default, you have to file under new regime after 31st July or 31st August or 31st October or 30th November. So many people will come and ask, now I have HRA deduction, I have the donation contribution, I could have claimed in old regime only. He did not come to us, so we did not file. That is different. But he don't know that he should come before, right? So we should tell him that if you want to file in the old regime, come within due date. Okay. So over the period of years, now we have also made our clients or associates who is individuals, we have told them we will not follow up. Okay, we will send an email. If you respond to email, we will file your return. And details requested will be sent in email. If you respond to that and if you give the data, we will file it. We will not even follow up with you. The practice is now established when we are able to get fantastic response. And we are able to file, I think in 23-24, by June 30th, we were able to file 75% of our returns. In July, it was only 25% pending. So as we structureize, I think people are also now getting educated and they are also becoming more intelligent and reciprocated in these kind of things. We should tell them, so it will work. I think in 23-24 also I was here for discussing ITR. At that point in time I told we had started this practice. Now I am telling you have successfully implemented that practice. So it is working and it should be working for everybody as well. Tenant PAN or TAN should be ready for HP filing because 194 IB and all of this will be linked. Ensure that you disclose all the owner and tenant information accordingly. Capital gain, document each transfer date. What is the transfer date? Many people misused the date last year, 23rd July 24. If it was prior to that, they could have got some benefit. They changed the transfer date only and put before 23rd July to claim indexation. Or if it is before 23rd July and if they felt without indexation 12.5% was more beneficial, they can change the transfer date to put it after 23rd July. This year it cannot happen, but make sure that you keep all those things appropriately. ITR 1 versus ITR 2 boundary check. So what is the thing that you already saw, right? Where ITR 1 is applicable, and in many cases there is a restriction. ITR 1 is for limited purpose reporting. So do a ITR 2 filing accordingly. And ITR U planning for FY21 to closing, where the 48 months or 36 months will get closed accordingly. You need to take care. Okay, wrong capital gain rates for transfers around 23rd July. That is something which is last year, renewed this year, it is not there. Default new regime trap, which we discussed. After due date, it cannot be done. And to go out. ITR 1 exclusions overlooked. Tenant PAN. ITR U time tire computation can happen different. So time that somebody can, as it is applicable, it is block of 24 months to 36 months. So wrong estimate and pay 50% instead of 60% and you become a mistake. So you have to keep accordingly. So I will conclude here. If there are any questions, we can take it up. I will be available 5 minutes after the session. Even if we are not able to interact now, I will be available to discuss for 5 minutes and then we can discuss there also. Yes, ma'am.
I received a summons from my client for 25-26 transactions. That he has deposited more than 20 lakh cash.
Summons.
Summon is received in April. It is dated 16th April. And nobody is interested in it.
If you want to take it up offline, you can take it, or you can continue. That's fine. Okay, you can take it up.
So,
Tax here. Correct. Okay, so we'll conclude and then if there are any questions, I'll be available and we can take it forward. Thank you for patient listening. It's been an immense opportunity and pleasure explaining things and exploring myself in detail in terms of preparation for this session. Thank you, Bangalore branch, and thank you, participants. Thank you very much.
Thank you, Kaushik, for coming and accepting our invitation. Thank you all the members for attending. But one request from my side, when the entire session you will all be here, last 2 to 5 minutes. We don't take much time to wind up and then do the vote of thanks and hand over the memento. It will be nice if all of you stay back, because the speaker has also come. You heard the speaker, but then when we are honoring the speaker, everybody is walking out. It doesn't look nice at all. Just respect the speakers and then stay back till we finish. That's my request to you all. And thank you for being here. And I wholeheartedly thank Kaushik CA here to be with us. Thank you. Good night and have a good night.